Top stories, blame game. UK Chancellor Kwasi Kwarteng says the BOE will be responsible if markets tank after its bond buying programme ends. All eyes on CPI, Asian stocks and treasuries decline before today's critical US inflation print. Fed minutes show a commitment to restrictive rate hikes. Plus, as OPEC trims its demand outlook, US officials fear their Russian oil price cap plan may fail. Putin warns all global energy infrastructure is at risk.
So, Tom, let's look at the futures for the moment. Pressure on the FTSE 100 futures down 0.2%. The DAX futures are also down 0.4%. If you look at currencies, there's fluctuating. Of course, a lot of caution in the markets. It's all about that CPI data, especially after, we had minutes and they kind of confused Wall Street. There was initially surging and then down on Fed expectations.
Yeah, committing to further rate hikes, but also saying that maybe there is coming a point at some point in the future where you have to recalibrate, or at least calibrate those rate hikes. And as you say, that did give some support to those markets, but at the end of the day, you had 6 straight days now of losses stateside. Here in Europe, a similar picture as well. And again, as Francine was saying, futures pointing lower. Currently, the FTSE 100 opening down 0.2%. So Bailey being thrown arguably under the bus by the Chancellor of the Exchequer. Of course, the Bank of England stepped in a big way yesterday in the gilt markets, buying up the most since that programme started on September the 28th. Over £4 billion worth of bonds and gilts purchased by the BOE. Questions, of course, continuing as to whether or not they really can close out this programme on Friday. Over in Spain, the IBEX is down by 0.4%. The CAC current is off by 24 points. Let's look at the cross assets. Again, on the losses that we saw yesterday stateside, futures pointing currently unchanged on the S&P futures. Still, of course, that wait-and-see approach to some extent. It could be a make-or-break moment for these markets as you look ahead to that all-important CPI print. The top line, the expectations from our survey is 8.1%, down from 8.3%. The pound currently at 110, down 0.3%. Further pressure on sterling. US 2 years currently at 4.31. That's a move higher by almost 3 basis points. And Brent at $92 a barrel, largely unchanged. Again, as the headline said, the Biden administration's concerns about that plan for a price cap on Russian oil. We're going to have a quick look at gilts as well, given the importance of what happened yesterday, what's continued to happen really since that mini budget, and the government continuing to insist that it's global events rather than their mini budget that is affecting what is happening in the gilt markets, despite all the evidence to the contrary. Here with the 30-year 483, not a lot of change there. The 10-year at 444. Again, not much movement, but you are seeing a bit of a bid for the front end. The 5-year 447, that's lower by 8 basis points, and the 2-year just currently holding at 4%. There's been a lot of volatility, of course, in these gilt markets, so we will continue to check in across the hour on gilts. Francine?
Yeah, we're also looking into some of the sectors that are on the move. Now, out of the 19 groups that make up the stock 600, only 2 are gaining. Only 1 is gaining, Tom. We only have energy gaining some 0.3%. Everything else is in the red. We also get that IEA report on oil consumption and oil demand across the world. That's in 1 hour from now. Technology down 1.3%. The biggest loser with real estate and utilities a close second.
Okay, let's get back to what is happening then here in the UK. Chancellor Kwasi Kwarteng says the Bank of England would be responsible for any market volatility after its bond buying programme ends tomorrow. Meanwhile, the Institute for Fiscal Studies has said the government may need to find £60 billion to shore up confidence. Over the week, economists and bankers have given their take on what is happening within the BOE and what is next for the UK's economy.
We've announced that we will be out by the end of this week. You've got 3 days left now. You've got to get this done.
The Bank of England can talk tough, but fundamentally, they're just going to have to extend this.
They are trying to hold things together as best they can.
The confusion, I think, comes between the financial side of the Bank of England and the monetary side of the Bank of England, which are now trying to do different things.
Monetary and fiscal policy being at crossroads, at cross purposes with each other, that's a very dangerous cocktail for bond markets.
It's been trying to maintain price stability and at the same time address financial stability issues with this other instrument.
This is not yet looking to me like a very steep and deep recession.
I don't think we're at risk of a financial crisis.
I worry that this is not enough, and I think they're going to have to come up with their version of whatever it takes.
By this time next year, the Bank of England will probably be cutting interest rates.
Now, to dive deeper into the story, let's bring in Bloomberg's Lizzie Burden and Ven Ram from the Markets Live team. So thank you both for joining us. Lizzie, I mean, I'm getting quite a lot of emails, actually, from viewers saying they feel like the game is really dangerous now here in the UK, especially the blame game between the Bank of England and, of course, Treasury.
Yeah, and we've also had the Business Secretary Jacob Rees-Mogg taking a swipe at the fiscal watchdog, the Office for Budget Responsibility, saying that, quote, its record of forecasting accurately hasn't been enormously good. So it comes back to the former BOE Governor Mark Carney's warning that this government is undermining the credibility of the UK's economic institutions. Kwasi Kwarteng is saying that it's going to be Bailey's fault if the market turmoil continues, if he sticks to his promise that the emergency bond buying programme will end tomorrow. But really, it means that Bailey's got to either sacrifice his credibility to continue the programme, or he won't be able to fight inflation. You know, these two programmes mean that he's got his foot on the brake and on the accelerator at the same time, and he looks beholden to fiscal policy. And you have to ask, how much would Bailey sacrificing his credibility on financial stability affect his ability to convince markets that his monetary policy is going to have a good effect?
Yeah, credibility in question for both the BOE and the government, the Chancellor at this point. Ven, let's bring you in then to kind of unpack the mechanics of what's happening within the financial system here in the UK and globally as a result of this standoff and the route that we're seeing, at least the volatility that we're seeing across the gilt markets. You've got everything from the pension fund crisis, of course, to CLOs and questions about sell-offs there, and more broadly, shadow banking concerns. Where are you focused in terms of the next stress points, the next areas of the financial system that could be under pressure, that could crack?
Morning, Tom. On an immediate basis, what I'm mostly looking at is the long-dated gilt segment, particularly the 30-year, which is more liquid. And that segment is going to tell us how this is going to play out once the BOE's backstop ends. If we see 30-year yields surging to anywhere near 525, 550 levels, and it's not just the level that matters, it's the pace at which the yields rise. If we see a big move like what we saw before the BOE came into the market, i.e., say 100 basis points in a matter of 3-4 days, it's like the BOE has to step in. They do not have a choice at that point. And the BOE's best hope is that it won't happen. And then comes the question of what happens to the broader markets, what happens to the pound and other risk assets.
But, Ven, first of all, can anything happen right now in the world of UK policymaking? And is there a chance, because of how many, actually, of bonds they bought yesterday, that the Bank of England will get it done in time by this Friday?
It's the best hope that, the asset managers will have squared up their positions, will have cut their undue leverage, and won't need extensive collateral. But that is the best hope. There are two ways this can play out after Monday. The best hope is for the BOE to think that, okay, the markets calm down, they've done enough of a backstop, and the markets go back to somewhat something that resembles normal functioning. The second scenario is the more nightmarish one, where, the markets are in tumult all over again, and the Bank of England is forced to step in one way or the other, whether it is through this backstop that we have seen, or through something else that is called differently, but essentially does the same thing.
Well, maybe what leads to that first scenario is a U-turn on these fiscal policies and these tax cuts by the Liz Truss government. So I'll put that to you, Lizzie. What are the odds of that? What are you hearing from your sources in Westminster? And on the question of the Bank of England governor, what are his options at this point?
Well, on the fiscal side, Liz Truss said openly at Prime Minister's questions yesterday she's not going to cut spending. So privately, her MPs are saying that it looks inevitable that she's going to have to reverse some of the other tax cuts. openly the Treasury Select Committee Chairman Mel Stride said that she'll have to do some rowing back, then in terms of Andrew Bailey's options, he could, as Ven says, stick with the gamble, hope that the market turmoil calms down. He could fold and continue the programme, which, as I say, will risk his credibility. He could stop quantitative tightening or pause it, which means that he can't fight inflation. Or perhaps there is a creative solution to be had in tandem with the Debt Management Office, which is part of the Treasury, where they raise short-dated money to ease pressure on longer-term debt. Now, that's not really been announced yet, but that's what we could potentially hear about tomorrow. Ultimately, the irony is that the Bank of England was so criticised for not doing its job to fight inflation. Then Liz Truss said that the BOE's independence is sacrosanct, and now her policies mean that, as I say, it's beholden to fiscal policy and it can't fight inflation because it's having to fight this fire.
Which means there's all this uncertainty as the clock ticks down to, of course, those fiscal plans being outlined by the Chancellor at the end of the month, and then, of course, the OBR, and then, of course, the Bank of England decision on November the 3rd. So much to work through.
Good luck to the markets until then.
Absolutely. Holding on to your hats across these markets. Not a lot of movement currently across gilts, but we'll continue to check in on the gilt markets, of course, for you. And the pound currently at 110. That's off by 0.3%. Lizzie Burden and Ven Ram, thank you very much indeed. Now, Miles Bradshaw, head of global aggregate bonds at JP Morgan Asset Management, joins us for his reaction to all of this. Miles, do you see the BOE? Good morning. Do you see the BOE having to continue its intervention beyond tomorrow?
Good morning. The short answer is, I think, yeah, probably. I think the more complicated question is to separate out the short-term pressures of market volatility from the longer-term dynamics. And the big picture is that because of the tax cuts, the UK now needs to issue a lot more debt, and therefore the yields on debt need to be higher to attract a new buyer. But we're all very focused on the accelerator, which is the volatility has created a deleveraging pressure amongst LDI accounts, and that's created risks about financial stability, and that's brought the Bank of England into the market. Now, I struggle to see how the Bank of England stepping back in a couple of days' time is not going to put more pressure. It's going to remove a key buyer. It's not going to put more pressure on the market, and we're not going to see greater volatility that will in turn require another policy response from the bank. It doesn't have to take exactly the same form, but it seems likely they will have to do something to help stabilize the market until you get some confirmation about the extent of the fiscal U-turn from the government.
But Miles, there are two issues, right? One is, I guess, the credibility of both institutions, as there's a clear blame game going on between the Bank of England and Treasury. First, how dangerous is this game? Does it actually, push away the credibility for all UK institutions? And how long does it take to get investors back? And then the second, I think, is as Tom was saying, on a more technical, what happens next?
Yeah, I think it is a very dangerous game. I mean, these are both the fiscal and the monetary agent that are actually almost having a public spat about who's responsible for volatility in the largest market in the UK debt market, which is the gilt market. It doesn't give investors confidence about how it's going to be resolved. And it appears that each one is trying to put pressure on the other one to actually pull a rabbit out of the hat and to enact some kind of U-turn. So I think it is a dangerous game. I think the genie has sort of come out of the bottle a bit. We saw with the Institute of Fiscal Studies that the savings that they need to make, the UK government, is in the order of 60 billion. The tax cuts are 45 billion. So what's happened is higher interest rates, slower economic growth has created a fiscal hole in itself. So somehow the government now has got itself in a position that a simple U-turn isn't enough to put themselves back to where they started. And that reflects issues about credibility of economic management. So it is more complicated. And then, the last thing is about tactically, how does the Bank of England manage this process? And I would say they haven't really been doing a good job. Yesterday we saw the largest purchase we've had in their program to date. It's happened just a few days before they said the program's going to end. Yesterday we had news the program was going to end, and there was a story that it wouldn't end. So we don't even know what the objective of the Bank of England is in terms of what are they trying to achieve. Is it trying to reduce volatility, in which case they should be outlining more clearly what they consider volatility and what they consider acceptable volatility? Is it about providing liquidity in the repo market? And that's what their repo facility they announced earlier this week was about. There is a lack of clarity, and that then means that the market struggles to understand what the policy objective is, and there's less signal. Yeah, there's less of a signal.
Miles, thank you so much. Miles Bradshaw, their head of global aggregate bonds at JP Morgan Asset Management, stays with us. Now, up next, we also look ahead to today's key data, U.S. CPI. That's what the market will move on the back of. We had a bit of a blip yesterday after the minutes from the Fed. This is Bloomberg.
Cryptocurrencies have been very popular. And if a client came to you and said, look, I'd like some cryptocurrencies in my portfolio, what would you say?
Oh, we've actually been really deep into crypto, deep into learning about blockchain, and all of the new businesses. You know, I would characterize us as crypto learners. You know, we have made a series of toehold investments on behalf of our clients, both in some of the currency baskets as well as with some venture firms that are investing primarily in the crypto area. I think it has the potential to be completely game-changing, but it is still such the Wild West, and so it's so uncertain. But it has the potential to completely upend everything.
Countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
If we do not see signs that inflation is moving down, my view continues to be that sizable increases in the target range for the federal funds rate should remain on the table. However, if inflation starts to decline, I believe a slower pace of rate increases would be appropriate.
For me, the bar for such a change is very high because we have not yet seen much evidence that the underlying inflation, the services inflation, the wage inflation, the labor market, that is yet softening. And so I think we're quite a ways away from anything like that.
Fed officials Michelle Bowman and Neil Kashkari there on the Fed's rate path and inflation goals. The comments came on the same day as the September Fed minutes were released and ahead of today's all-important CPI print.
Now joining us is Christina Kino. Miles Bradshaw as well, head of global aggregate bonds at JP Morgan Asset Management, is still with us. So Christina, we'll get onto the pound movements in a second, but Miles, we're talking a little bit about the pension funds and the overall volatility that we saw in pensions. Does it change the way they work? So are we going to have, this is a great question also from a viewer, is it going to be less risky, much more like the US pensions model?
I think in the short term there will be a huge pressure, quite rightly, for pension funds to build up their liquidity buffers given the volatility they're seeing in the market. Longer term, there's probably going to be a review at some point about what is the appropriate level of leverage and appropriate level of liquidity that are held in these liability sleeves of pension funds. And I would expect the conclusions to be there should be less leverage. There should be more liquidity, which will make them more robust to kind of unexpected market shocks. That would be my expectation, but that will take, that will take years to complete that review.
Two very clear risks, and we were talking to Mars about these in the break, Christine. One of them, of course, being the strength of the US dollar. I just wonder how you are thinking about the greenback in light of the minutes that we got from the Feds and some comments that led to a little bit of optimism, at least immediately on the back of the publication, around the way that maybe there's going to be some calibration. Maybe December is the month we look at where you start to see a bit of an adjustment.
Yeah, the minutes were very interesting, Tom, because I think it contained the nuance that we didn't necessarily have over the summer, and that is a recognition of the global risks that Fed policy poses. And, the Fed, of course, insists that they are setting policy for the U.S. economy and the U.S. economy alone, but of course they can't be blind to the fact that it is the most important central bank in the world, and it will have reverberations, whatever it is that they do across the global economy. Now, over the summer, of course, the Fed were suspiciously silent about the strength of the U.S. dollar, because this is not, just a story for now. This has been a story for all of this year, and even companies in the U.S. had started complaining in the summer about the strength of the U.S. dollar. We didn't really hear from either the Fed or the U.S. Treasury then, but I think now into the autumn, and we're starting to see kind of the global economy really deteriorating a step further, that the Fed's starting to recognize those risks, and potentially something, with the calibration comes a little bit of a ceiling for the U.S. dollar as a result.
At the same time, Christine, is this like a warning shot for other countries? I mean, we've been asking that question for the last 3 weeks, and it feels like now there's the ripple effect, right, of UK into elsewhere.
Absolutely, Francine. I mean, we've been seeing, right, in real time just how much the sell-off in gilts, the sell-off in the pound has reverberated across global markets. It's certainly something that other economies are watching, one, as an example of how not to do fiscal and monetary policy, but also, two, as an example of how a sudden and rapid or sudden and large decline in bond markets really can just spread those risks around. I mean, in the UK, what we're seeing now is kind of a spreading of the sell-off from the bond market into other assets, as these pension funds still struggle to kind of come up with the cash for their collateral calls. And that's something I think that the world is watching very nervously, because there is a lot of potential for a ripple effect and a systemic shock here.
Okay, Mars, let's see if we can end this on something of a positive or optimistic note. Where are you finding value in these bond markets at this point, Mars?
Well, I think the optimistic note is the thing about bonds is that as prices go down, yields go up, and that means valuations become more attractive. So that I think is the silver lining, is that we're getting the value as a private investor who's investing for economic reasons. You're looking at better value in bond markets, and that makes things attractive. I think right here, right now, in terms of the global bond market, to me, it's the Chinese bond market that represents the best value, because the economic outlook in China is very different than it is in the US and Europe. And in terms of the European bond allocations, we have been underweight duration for most of this year. We're reducing the size of those positions because value is coming in. Real yields are approaching at the very front end levels of 2007 in the US. And, the Fed rate hike path is beginning to slow. That's our expectation, and it will be restrictive. So I think that's the silver lining. Higher yields is actually creating value for investors.
Okay, thank you very much indeed. Miles Bradshaw, head of global aggregate bonds at JP Morgan Asset Management. Potentially some opportunities there, local rates in China amid everything that's going on across these bond markets. Of course, Christine Aquino as well, walking us through some of the key market themes. Coming up, the blame game, that's having ripple effects, of course, as we mentioned, across the global bond markets. We're going to stick with the standoff then between the Bank of England and the UK government. This is Bloomberg.
everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrell. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg.
Welcome back to the Open, everyone. 25 minutes into the European trading day. This is a picture across the board. Shares continuing their decline, currencies fluctuating. A lot of caution in the markets ahead of CPI later today in the U.S. Of course, we keep a very keen interest in what's happening in the UK. Now let's get straight to the Bloomberg Business Flash. Here's Alice Atkins. Hi, Alice.
Hi, Francine. ASML has ordered its US staff to stop servicing customers in China after the Biden administration announced tighter restrictions. The Dutch chip manufacturing equipment maker told its employees in America about the rule changes in an email. ASML has held back from selling some of its most advanced technology to China as it tries to strike a balance between the two nations. The US is considering a total ban on Russian aluminium in response to the military escalation in Ukraine. Bloomberg's learned that the Biden administration is weighing a number of options, including an outright ban or a large increase in tariffs. Russia is second only to China as a producer of aluminium, which is crucial to most heavy industries. That's your Bloomberg Business Flash. Tom, Francine.
Alice Atkins here in London. Thank you very much indeed. Coming up, our next guest says trading on the gilt market will continue to be bumpy for a while, but the UK is not an exception when it comes to liquidity risk. We're going to speak to Allianz Chief Economist Ludovic Subran. That is coming up next. Your markets here in Europe currently pointing lower by 0.3%. The S&P E-minis, though, stateside, pointing to very modest gains of a little over 0.1% after 6 days of losses. Stay with us. This is Bloomberg.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball so their apps would surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are in Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Blame game. UK Chancellor Kwasi Kwarteng says the BOE will be responsible if markets tank after its bond buying program ends. All eyes on CPI. Stocks and treasuries decline before today's critical U.S. inflation print. Fed minutes show a commitment to restrictive rate hikes. Plus, as OPEC trims its demand outlook, U.S. officials fear their Russian oil price cap plan may fail. Putin warns all global energy infrastructure is at risk. Tom, if you look at the markets, they just want to know what's happening with U.S. CPI. After that, minutes were a little bit confusing. Maybe a bit of expectation, but it was very short-lived, that the Fed wouldn't hike as much as priced in.
Yeah, two things that came through from the minutes was they're going to continue to hike rates, but also calibration. That was a word that was used and that some in the markets clinged on for some optimism that maybe, at least come December, you start to see a moderation from Fed officials. That debate still live, of course. And the focus, yes, is on the CPI print out today. For so many investors, 8.1% is the Bloomberg survey, down from 8.3% in the month of August. And of course, if you get anything significantly above that, you should expect and would expect further pressure across these markets. Already, markets, of course, pricing at least 75 basis points come November for the Federal Reserve. Across the benchmark here, you're seeing losses of 0.4%. The DAX, though, in Germany, just clinging on to some very slim gains. Here in the UK, the FTSE 100 down by 28 points, off by 0.4%, of course, as the war of words, at least, between the BOE and the Chancellor continues. The last time I checked the gilt markets, there was a little bit move towards the back end of yields lower, but of course it's been incredibly volatile with that step in by the BOE yesterday towards the end of the day of £4.4 billion of purchases, the biggest intervention since that programme was started. And of course the questions remain as to whether or not they can really pull out come Friday. In terms of the sectors that are green this morning, at least 30 minutes into today's session. Travel and leisure at the top of the list is gaining 0.9%, and autos as well. Also in positive territory, up 0.7%. Most other sectors, though, in the red. A bit of a holding position, again, ahead of that all-important inflation data. Let's return then to our top story, the standoff, yes, between the Bank of England and the UK Chancellor. Bloomberg's Tom Metcalf is here. Tom, what are you expecting today then from the markets? There hasn't been a whole load of movement in the gilts so far, but we know just how volatile these sessions can be.
Yeah, exactly. It's a bit calmer today, which I'm quite thankful for, actually. And I think standoff is probably the right word. And I'd actually sort of construe it as a three-way standoff. You've got, obviously, the government or the Treasury on one side, the Bank of England, but then also the markets, which will obviously play the biggest role in deciding what happens. So, I think a lot of the attention is probably going to be towards how big this auction is later this afternoon. Yesterday it had a decent size, about £4 or £5 billion. And maybe if they really go close to that £10 billion limit, that will continue to calm the markets. But obviously there's this big cliff edge coming at the end of Friday. This is in no way ended.
So, Tom, how does this pension crisis actually tap into these wider fears about shadow banking?
Yeah, we were looking at this because, you know, obviously this gilt crisis is capturing the headlines, but what it's also doing is showing that, hey, there is this huge problem that regulators have been sort of worried about for years, and this is really kind of sharpening those fears about it. So this is, you know, the system which isn't regulated banks, which most people feel are going to be well capitalized to handle anything, but it's more the situations you don't expect, precisely like this LDI strategy, which is going to cause the problems, and, you know, those are mounting up across the board. So, you know, whatever happens with the pensions crisis, I think there's going to be a lot more sort of shoes to drop.
Yeah, the ripple effects. And I know, Tom, you and the team have been charting this, whether it's the potential sell-off in collateralized loan obligations, the global implications of all this. So what are you watching for next?
Yeah, I guess looking for the early warning signs, right? And, you know, a couple of areas. Obviously, housing is such a, you know, beast in the room. But I'd also actually say car loans as well is one area we're just kind of keeping an eye on and seeing if they'll sort of flag up early signs of distress. That and you're dead right. It's not just about the UK. This is a global story. It's just happening to sort of take shape in the UK for now.
Tom, thank you so much. Tom Metcalf, they're in charge of all things financial at Bloomberg. Now, our next guest says trading on the gilt market will continue to be bumpy, but the UK is not an exception when it comes to liquidity risk. Now, Allianz chief economist Ludovic Subran joins us. Ludovic, thank you so much for joining us. I know that this could be a global concern, but this feels like it was sparked by something very, very UK-centric, which was this mini budget, and now the blame game between the Bank of England and Treasury is not helping.
Do you think it is that peculiar to the UK? I have the impression everybody is doing a mini budget as we speak, you know. My own country, you know, the country where I work, Germany, we're announcing billions and billions to do whatever it takes again against the energy crisis without even trying to target the support, because we think that throwing money at the problem is going to help, right? So I would say that I'm a bit more worried about something of a collateral winter, of a collateral squeeze winter. So these liquidity risks are everywhere. You know, the IMF and the World Bank annual meetings, I would be very worried about some emerging markets. We're also looking at some specific, asset classes. So I think the UK is a bit of a textbook of what not to do. But unfortunately, I think a lot of central banks, for example, are watching as the BOE does, one communication error after another to not try to do them. But they're going to have similar issues. You know, how do you continue to hike when recession is already there? How do you make sure that you don't create financial stability risk when the dollar liquidity is drying up like never before? This is, unfortunately, the problems that most policymakers are facing in more countries than the UK.
So Ludovic, we brace for more volatility then in the Eurozone, presumably. I mean, how much of this kind of risk is priced into the markets at this point?
I don't know. I can tell you that the 30-year Greek bond is more interesting than the 30-year UK bond. That tells you a little bit about, debates that we've been having for quite some time on Grexit or Brexit. So I think, Tom, the real issue here is, I think, no liquidity risk is ever priced, right? And what has happened, for example, to the gilt market, the meltdown is exactly a case in point. So the big question is, where should we be more worried? I'm worried, for example, in the emerging market, Eastern European markets, some African market, Latin American market. And in the Eurozone, I'm more worried about corporates. I think, this recession, this manufacturing and trade recession is a triaging one. Governments are trying to do a form of whatever it takes, but can it really help companies that will have very little energy, that have a very high labor bill, and that are very indebted in the transport, in the retail sector? So I'm more worried about the corporate sector. But again, the sovereign bond market is also something to watch if the ECB makes mistakes. But they're watching very carefully what the Bank of England is doing, just to not communicate the way they did. That's for sure.
Ludovic, is there a danger that actually we go back to the kind of crisis that we had in 2008? I know there's a lot of concern, certainly here in the UK, about shadow banking. Now, I know that every time there's a sharp rise in interest rates, we're definitely getting at the moment, especially after that, 10 years of low interest rates, you have to look at the people that are leveraged, where the leverage is comfortable at 1%, but not at 6%.
This is interesting, Chrissy, because I think, everybody is focusing on regulated institutions, but as you know, we have a lot of non-banks, we have a lot of buy now, pay later institutions. In Allianz, we have a company called Allianz Trade that has this working capital financing, type of insurance. And to be fair, we are also worried about another type of liquidity, which is liquidity to the firm. When you look at the cost of inflation so far, it's been, eroding a third of the cash on balance sheet of households. And most of the households have actually started to increase debt again. So debt on EBITDA is extremely high. It's actually at record level in most European countries. And this is indeed not only related directly to the banking sector, but it's also related to the way they manage their working capital, their treasury, and more generally, the type of B2B lending practices that they've had. And so, of course, we're concerned about this because we don't have a full picture of this type of leverage.
So what are you seeing in terms of corporate defaults? We know that balance sheets have been healthier or are healthier because a lot of these corporates have been loading up on cheap debt over recent years. But that stress is now there. Are you seeing a tick up in defaults?
Yes, to be fair, we see at least an increase of, so it depends what you talk about defaults. But in the real economy, for example, bankruptcies, we see already bankruptcies increase. It started in Spain, in Europe, and then in the UK very clearly. And now it's reaching Italy and then France and Germany. So in 23, we think there is a real normalization of the number of bankruptcies. And so this is because, a lot of the grace periods on some of the payments, for example, for Social Security in France that were granted to companies is coming to an end, right? So there is still a lot of measures, and the German government just announced a bazooka measure to corporates. But to a certain extent, will that help when your order books are already plummeted because you have a demand-driven recession? And basically, you still have very expensive cost of supplies, right? And cost of functioning. So I think we're going to see a normalization of default. And then on the market, I think I'm concerned about fallen angels. I'm concerned about, all of these corporate that were close to high yield and who currently still benefit from relatively benign spreads when everything in the sovereign bond market is going to shambles. So I'm a bit concerned, that at one point there is a reality check on the real status financial positioning of these companies. But the good news is that most of them, I would say, have stronger balance sheets because they still have some cash, but some of them are extremely worried, yes.
But Ludovic, how much are you looking at markets now? I know you're an economist and one of the very best out there, but if there's a seizing of funding, how quickly does it transform into the real economy or into a crisis?
You just mentioned before this segment, Francine, that the Fed is going to have to pause. I think it's going to be the same in the ECB. And I think what we see in the Bank of England with this form of QE, which is not QE, I know, but which is a form of intervention, we're going to see a lot of central banks being extremely worried about financial stability. So they may have actually slightly higher short-term rates, but they're going to have maybe to do some form of intervention on the balance sheets on the longer term of the curve, or maybe on some classes like corporates. So we are entering a world, if it's war includes debt monetization, war includes some form of yield control. So I think central banks are going to be put to the test here in how they can tame inflation pressures and anchor inflation expectations while they ensure financial stability, and that includes through balance sheet moves. So you call it QE, you don't call it QE, it's a form of balance sheet intervention because the drying up is so fast.
Always fantastic, always excellent. Ludovic Souperin, Allianz Chief Economist, on the bankruptcy and default risks and the pressure on these central banks. Thank you. Coming up, we look ahead to today's key data. Yes, it is US CPI day, and how, of course, it could impact the Fed's next move. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one, and through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
For a young person who now looking at a career, would you recommend a Wall Street career today?
There are not many jobs you can have as a young individual where you're always learning.
It's a pretty amazing environment. You know, obviously, not to discount that there's lots of risks in the world. We've never seen this kind of volatility, up and down. You know, all of us here. You know, the ups and downs intraday.
There's a hunger. There's a risk appetite.
We're pinching ourselves a little bit that, you know, where yields are today, you know, globally.
Equities and credit in a more bottoms-up way is a journey we've been on, and you can expect us to keep mining that direction.
I think we're all looking around saying, wow, you know, right now we can get, you know, what was 6.5% on the CCC index a year ago is now the yield on the investment grade index. We're doing more trading because there's more opportunity caused by this volatility.
Guest speakers at the Bloomberg Invest Conference in New York on opportunities in the current market volatility. Checking in on your markets just briefly, European stocks, the benchmark down 0.3%, but future stateside pointing up by 0.2 on the S&P E-minis. Fran.
Now, Tom Saba, capital management founder, Buzz Weinstein, says the uncertainty that's currently gripping markets could endure for a long period. Now, the hedge fund manager spoke to Bloomberg's Barry Ritholtz in an exclusive interview.
I'm used to, and we're all used to, sell-offs that are fairly quick, that we know, even 08 was 5 or 6 months from Lehman to the lows of March 09, where at the end of it, you can kind of wonder, is there an all-clear sign? We have the Fed behind us, quantitative easing. Now we don't really know who the savior is, because at the end of all of this, we're still going to have quantitative tightening and shrinking the balance sheet. And so whereas a lot of sell-offs were just a prelude to a bull market 1 or 6 months later, you know, this has the feeling to me like we're going to be worried about some number of these things or new things for potentially quarters and maybe even years to come.
So no capitulation yet, no flush, which gives us that all clear signal. How much of that is based on truly not knowing what the Fed's going to do, or is it we don't know which potential problem is real and which is fake news?
These things are so hard to predict. I even want to be cautious about, you know, opining too much, because it's just such a confusing market, and there hasn't been a single thing to say, okay, this is why the market, why 20% is not enough. It should be 40. Let's take inflation. If you look at forward inflation, it's expected to come down a lot. So you could look at tomorrow's CPI print, if it comes in a tenth or below or high, and get excited about it, but the market is still telling you inflation is not going to be the problem that it is 1 year from now. Now, if a few months from now that conviction is shaken, then we're going to have a real strong sell-off. If somehow Russia, heaven forbid, becomes more asymmetric, we're going to have a real problem. And so we just don't know. We're in a fog, and we should not rely on the lessons that people learned maybe incorrectly for this environment that were good between 08 and 2022, which was the Fed is your put, don't fight the Fed, and dips should all be bought, and being short is fighting the Fed. You know, this really does not feel like that environment, in particular because of where the central banks are versus then.
That was Saba Capital Management founder Boaz Weinstein. And let's get the Bloomberg First Word News now with Alice Atkins. Alice.
Hi, Tom. The head of the IMF says Ukraine will need at least $3 billion a month next year to finance its wartime economy, which means allies will have to give more support. At a meeting in Washington, Kristalina Georgieva also warned developments in the war could push financing needs even higher. Russia's President Vladimir Putin says any energy infrastructure in the world is at risk after the explosions on the Nord Stream gas pipelines. Speaking at a Moscow Energy Forum, he blamed the damage on the US, Ukraine and Poland, calling them beneficiaries of the blasts. Various reports have suggested the sudden leaks were an act of sabotage. American conspiracy theorist Alex Jones has been ordered to pay almost $1 billion in damages after repeatedly claiming the 2012 Sandy Hook school shooting was a hoax. The Connecticut trial was the second to hold Jones financially accountable for his lies about the massacre. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom, Francine.
Alice Atkins here in London. Thank you very much indeed. Coming up, trouble ahead for tech. The world's most valuable chip company slashes its 2022 capital spending target. We'll get the details. This is Bloomberg.
the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Welcome back to the Open. 52 minutes into your European trading day. Briefly checking in the markets. Down 0.4%. Markets, of course, waiting for that all-important CPI print out of the US in terms of determining just how aggressively this Fed has to go on inflation. Just briefly checking in on gilts as well, given the tumult in these markets and the end, at least a proposed end of the bond buying by the BOE tomorrow. Currently, yields down at the long end, just between 2 basis points on the 10-year, lower by 6 basis points on the 30-year, but just slightly higher by 2 basis points at the front end on the 2-year, currently trading at 4.0%. 3. Okay, for more on all these market questions and themes, let's bring in Bloomberg's Jan Patrick Barnett. So Jan, JP, the BOE and the Fed continue, of course, to dominate market sentiment. Which for you is the most important factor and player in the session today?
Well, I would say for today, it's definitely the CPI print that we are looking for. It's so highly anticipated, and people are keen to see like where the inflation path is going. But of course, the BOE is also creating a mess here and is adding another layer of uncertainty into the market, which we really don't need at this point. And I find it very telling that Mr. Weinstein, a man with like decades of experience in the market early on the program, said that this market is so hard to read with all the uncertainties going on. And that's very telling when someone with that experience tells you that.
Yeah, many people saying there's so many concerns coming from all sides that it could really end up being the perfect storm. JP, chip makers continue to tumble. The industry appears to be bracing for a potential recession.
Yes, and another storm we have there, and that's also quite telling, given that chips are part of our everyday life these days, and it tells you where the economy is probably heading, and that also tells you the big gap or the big step that the central banks have to do now. We all believe that they still will save the day when push comes to shove, but they need to make this thing happen to cool down the economy, to let inflation come down, but at the same time not to kill the engine completely. And it's still very unclear to me if this pull-off will work.
Yeah, TSMC cutting their planned expenditures by about $10 billion, just as an indicator then of their concerns about demand growth, particularly for areas like smartphones. Swinging it back to the BOE, JP, before we let you go, not a lot of volatility, at least at this point, 54 minutes into the trading session for gilts. Do you expect these yields to be capped and this volatility to ease as we look ahead to the end of play tomorrow?
Well, that strongly depends on the wording that we are seeing next right now. I mean, this seems to be a bit of a tug of war between the political leadership and the monetary policy leadership, so to speak. And the question is, like, who blinks first? It makes no sense to me to do this at this point in time. There are so much issues going around in the world, so the last thing we need is another blow up here. So I really hope that usually it's the central bank who is the wiser end, that they do the right thing and help to calm down that market.
JP, thank you so much. JP Barnett there on the very latest with some of the markets. Now, some of our stories that are doing extremely well in the Bloomberg terminal, UK companies now facing some of the loan requests from their pension funds. Now, this is a story from our pension expert, Lucia Giftopoulou, saying that, look, they're now facing calls, Tom, to provide some of the liquidity or some of the emergency loans to their employee pension schemes. And again, this is where liquidity comes into play. We know we have a backstop from the Bank of England through some of the refinancing facilities, but tomorrow's really crunch time.
Yeah, that's quite a development, isn't it, when the corporates are being told to lend money to their own pension plans to tie them over, as we, of course, know that pension funds are readjusting and trying to get their house in order, again, by that deadline, and the clock is ticking. If the BOE is indeed going to stick with this, of course, questions remain as to whether or not they will have to fold ultimately and continue that support. And other top stories, of course, include what is happening with CPI, and that expectation, just to remind viewers, 8.1% is the estimate then for the month of September, after 8.3%. And we have there's a great blog on the MLive around how the markets could adjust to either a 10 basis point, 20 basis point move either side of that. Just the expectations around the uncertainty when it comes to inflation, particularly the question of core and rents as well. Currently, your market's down 0.3%. US markets holding on to very slim gains at this point, Francine, 0.2% for the S&P E-minis.
That's it for the European market open. Surveillance early edition is up next. We also have a great interview with the Moderna chairman. So we'll talk about vaccine, some of the bivalent vaccines and what they mean for the future. This is Bloomberg.
of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
Wall Street prepares for the latest read on inflation.
Peak Fed, peak hawkishness. We're getting carried away.
The market's been right.
Are rate hikes starting to pay off?
How long is it going to take to see progress on inflation?
The Fed just has a long way to go.
Instant reaction on Bloomberg surveillance.
Inflation is still sticky.
The U.S. economy is still on track.
And what it means for the Fed.
The data will tell us.
I think we're quite a ways away from a pause.
This is a Fed that will blink.
The prudent thing to do is to ease off a little bit and just have a look around.
Inflation in Focus, tomorrow on Bloomberg. Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrell. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Well, blame game. UK Chancellor Kwasi Kwarteng says the BOE will be responsible if markets tank after its bond buying program ends. All eyes on CPI. Stocks fluctuate before today's critical U.S. inflation print. Fed minutes show a commitment to restrictive rate hikes. Plus, as OPEC trims its demand outlook, U.S. officials fear that the Russian oil price cap plan may fail. Putin warns all global energy infrastructure is at risk. Now, let's check in on the markets. We're also getting the IEA report crossing now on the Bloomberg terminal, so we'll get that to you as soon as it breaks. European stocks a bit under pressure, down 0.4%. The focus firmly on what we're seeing with the U.S. CPI a little bit later. So you're seeing a lot of equities actually extending some of the decline, caution prevailing before that highly anticipated U.S. inflation talk. The focus also on the UK 30-year yield. We're now hearing pension funds on what they can do to try and get facility. The main concern, of course, is liquidity out there. Corporates may be asking, or regulators may be asking corporates to put money into their pension funds to make sure that they're okay. The blame game between Treasury and, of course, Bank of England absolutely not helping. And then finally, we look at pound 110.85. The focus firmly, though, on oil. OPEC Plus cutting the risk to the oil price spike and world recession. This is a warning from the IEA. So we'll have a full round on what happens to the IEA. I think we have a European map, but it'd be nice also to look at the price of oil maybe on a 1 month chart. So the FTSE gaining, or actually down some 0.5%, a similar loss for the CAC 40. So that's a picture across the board for the IEA. We'll have plenty more, of course, on what we heard from them. IEA warning that OPEC Plus cuts risk oil price spike and they risk a world recession. So the Chancellor, Kwasi Kwarteng, says the Bank of England would be responsible for any market volatility after its bond buying program ends tomorrow. Now, speaking on the sidelines of the IMF's annual meeting, the Chancellor told Sky News that any turmoil is, quote, a matter for the governor. Well, economists and bankers gave us their take on what is going on.
We've announced that we will be out by the end of this week. You've got 3 days left now. You've got to get this done.
The Bank of England can talk tough, but fundamentally, they're just going to have to extend this.
They are trying to hold things together as best they can.
The confusion, I think, comes between the financial side of the Bank of England and the monetary side of the Bank of England, which are now trying to do different things.
Monetary and fiscal policy being at crossroads, at cross purposes with each other.
That's a very dangerous cocktail for bond markets.
It's been trying to maintain price stability and at the same time address financial stability issues with this other instrument.
This is not yet looking to me like a very steep and deep recession.
I don't think we're at risk of a financial crisis.
I worry that this is not enough, and I think they're going to have to come up with their version of whatever it takes.
By this time next year, the Bank of England will probably be cutting interest rates.
Well, for more on this, let's bring Bloomberg's Lizzie Burden. Lizzie, it seems that the Chancellor and the Governor are playing a game of chicken. What happens next?
Well, you've got the pressure on the government to U-turn on their tax cuts because, of course, in Prime Minister's questions yesterday, Liz Truss said she's not going to cut spending. So if she wants to balance the books and restore any credibility in markets, she's going to have to change something. Newspapers reporting that corporation tax could be the next reversal. And then on the Bank of England side, again, Andrew Bailey under massive pressure to U-turn. He came out guns blazing this week saying that the emergency bond buying programme is going to end tomorrow, but now Kwasi Kwarteng saying if the market turmoil continues, it's going to be on Bailey. If Bailey has to continue the programme, then it's going to risk his credibility, and it would mean that he isn't able to fully fight inflation. And the chief economist Hugh Pill said this week that that needs to be the BOE's priority. So you have to ask how much of a U-turn from the Bank of England, if there is a U-turn, how much of an effect, of a spillover effect there would be in terms of monetary policy, because markets have to believe what the governor says.
What options does Bailey have now?
Well, he could continue with the gamble, end the programme on Monday and hope that the market turmoil ends. He could fold, he could continue the programme, but as I say, that has risks for credibility. He could stop or delay quantitative tightening, but again, that means he can't fight inflation. Or perhaps there's a creative solution to be had. This is what strategists at HSBC are saying, where the debt management office, which is part of the works as part of the Treasury, buys shorter dated money to ease up space at the long end. Really, that hasn't yet been formally been put on the table, but what it shows is all through the summer, the Bank of England was criticised for not doing enough to fight inflation. Then the government seemed to row back on that and said that independence was sacrosanct. As it stands, the Bank of England can't be fighting inflation effectively, nor is it looking as if it's independent from fiscal policy. Bailey in a very difficult place.
Certainly. Lizzie, thank you so much. Lizzie Burden there outside the Bank of England on Threadneedle Street. Now, the deterioration of the global economy and higher prices sparked by an OPEC Plus plan to cut supply will slow world oil demand. That's according to the monthly report from the International Energy Agency. Now, it comes as sources say that some Biden administration officials are growing concerned that their plan to cap the price of oil purchase from Russia may actually backfire after the OPEC Plus alliance's surprise production cut last week. Now, we're joined now by Toril Bozzoni, of course, head of the IEA's oil market division. Toril, thank you so much for joining us. First of all, it's a pretty stark warning when it comes to what we saw over last month, and I know you're worried about a global recession. Where would you see it first?
We're already seeing the economy faltering here in Europe, in the US. All the major institutions continue to downgrade their outlook for the economy on a monthly basis. So what we're trying to say with this report, the higher prices feeding into inflation, forcing governments to cut interest rates, we're saying that the macroeconomic environment might deteriorate further.
So, Toril, talk to me a little bit about what we see next. I know, if we look at the production cuts caused by OPEC or put in place by OPEC that might cause a recession, are you actually calling OPEC Plus to reverse course?
We're not calling on OPEC we're not setting their policy. Obviously, this is for the OPEC to decide. What we're saying is that by cutting supplies to the market, it's preventing a rebuilding of inventories that are still critically low. So we think that by reducing supply at this time, the lower inventories. OECD inventories is still some 240 million barrels below the 5-year average, and they would have been even much lower than that had it not been for IEA member country stock releases. So we think that if we were allowed to let the inventories rebuild, there would be it would be help to reduce the volatility and deflate the inflationary pressures.
So, Tora, where exactly does the IEA stand on releasing these strategic stockpiles?
So, as I said, now from March to September, IEA member countries have released more than 200 million barrels of government stocks. Those stock releases are still ongoing, and in October, November, there is more oil that will be released from strategic reserves of member countries. Going forward, of course, the IEA member countries still have emergency reserves that they can use in case the market tightens too sharply, but we're still completing the stock releases that were agreed in March and April of this year.
Talk to me a little bit about China. So we know that, or according to your report, it's heading for its first annual demand drop since 1990. How big a deal is this?
It's a very big deal. China has been driving oil demand growth for the past decade. And this year, we're seeing Chinese oil demand declining by about 600,000 barrels a day. In August, Chinese demand was 1.3 million barrels a day below last year's level, which is obviously a big deal. Now we're seeing that the government is still fighting to control the spread of COVID. New restrictions are put in place, which has led us to reduce our expectations for Chinese oil demand for the rest of this year and into 2023 as we see this policy impacting demand going forward.
Tora, how worried are you, if we take a step back, how worried are you about the next 6 months, the volatility and everything that could ensue if there's not a reversal?
No, of course, as we say, it comes at a bad time for energy markets. We're in the middle of an energy crisis. It's not just oil markets, but gas market, electricity markets. We are just weeks away or months away from the embargo, EU embargo on Russian oil that comes into effect for crude oil in December and products in February. And how that would play out, how Russian oil production will respond and exports will be allocated. It could have a significant tightening of the market, but we yet to see how that will play out. EU countries have reduced their purchases of Russian oil, but they still import more than 2 million barrels a day, 2.5 around, that they would have to replace by other sources. So this is still something that is in progress, and we will have to see how that works out. So there could indeed be a tightening of the market as we move forward.
Tora, as we look at possible blackouts in Europe, as you know, we try and understand really day in, day out, hourly, the situation with Russia, what should you be looking for in terms of signs maybe of easing of this energy sector, or is there really no chance of that?
So what we're seeing with Russia, of course, there has been a big reallocation of trade from into Europe, the U.S., Western country to the East. Now, in September, we saw actually Russia shipping more oil to East than they were to Europe and the West for the first time. But we think that this reallocation will be complicated also as the EU ban on maritime services comes into effect by the end of the year. So this is where we still have to see how the trade flows will reallocate and what the real impact will be on Russian supply and on global energy markets.
There was also this you know, frankly strange story. Vladimir Putin saying that all infrastructure is at risk after the Nord Stream hit. Is this a veiled threat to the whole world? How do you interpret this?
It's obviously a big concern. I mean, we're seeing the Nord Stream pipeline infrastructure. We're seeing activity in the North Sea. Obviously, oil producers and gas producers are worried. Infrastructure security is part of the bigger security threats that we see in energy markets today, and it's something that we're watching very closely.
Toral, thank you so much. Toral Bozzoni there, head of the IEA's oil market division, joining us this morning on the back of this very important report. Now, coming up, Chancellor Kwasi Kwarteng says the responsibility for any market turmoil after BOE bond buying ends is a matter for the governor. More on the UK next. This is Bloomberg.
Cryptocurrencies have been very popular. And if a client came to you and said, look, I'd like some cryptocurrencies in my portfolio, what would you say?
Oh, we've actually been really deep into crypto, deep into learning about blockchain, and all of the new businesses. You know, I would characterize us as crypto learners. You know, we have made a series of toehold investments on behalf of our clients, both in some of the currency baskets as well as with some venture firms that are investing primarily in the crypto area. I think it has the potential to be completely game-changing, but it is still such the Wild West, and it's so uncertain. But it has the potential to completely upend everything.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full service shadow banking with nobody in charge.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the UK is in crisis mode. The Chancellor, Kwasi Kwarteng, says the Bank of England would be responsible for any market volatility after its bond buying program ends tomorrow. Speaking on the sidelines of the IMF's annual meeting, the Chancellor told Sky News that any turmoil is, quote, a matter for the governor. Now, for more on what's more, the Prime Minister, Liz Truss, insists that she will not cut spending or make any further U-turns on her tax cuts. Now, we're joined by William de Vilder. He's chief economist at BNP Paribas, and Christina Aquino from our markets team. Christine, first of all, the markets are worried about the inflation report from the U.S. and what that means for the Fed. But there's also a spillover effect of what we're seeing in the U.K. to the rest of world bonds.
Absolutely, Francine. I mean, the world is really watching the UK in terms of how it's handling this latest crisis, and it's not doing great in terms of that global impression. I mean, just earlier this week, the IMF chief economist singled out the UK as a country that's showing other global economies how not to handle a fiscal and monetary policy kerfuffle, as it were. And, you know, this latest line from Kwasi Kwarteng really is not calming markets necessarily. I mean, investors really want to have faith in their institutions, want to know that they have their backing if things go awry. But this latest line from Kwasi Kwarteng, especially ahead of that BOE pulling back from the market tomorrow deadline, is not calming nerves at the moment.
So, William, what's your take on all of this? I don't know whether this is a very dangerous game that really goes to the credibility of the UK, and whether this will take months to play out to regain that market credibility.
Well, credibility lost, it takes a long time to gain it back. That is what we all know. I think what are the takeaways from the developments in the UK? First of all, I was impressed and surprised by the extent of the global spillovers, that the jumping gilt yields were pulling along to such a degree yields on the European euro area, but including treasury yields. The second point is that clearly, from a policy perspective, we need to have a proper coordination between fiscal policy, monetary policy, and macroprudential. Macroprudential means that we need to have a clearer picture of where is the leverage in the system. And then fiscal, of course, well, if you're trying to slow down the economy with monetary, you should not inject more money by expansionary fiscal policy. So that is, I think, where we really have an issue. And the third point, and that is also an element of concern for the longer run, is that pension funds play a key role in financing the economy. But that goes beyond the UK, it's really the global economy. Yeah. So if you have disruption happening there because of the LDI and all the like, we still fail to come to grips with what could be the longer-term consequences for financing certain assets.
But William, talk to me a little bit. So where does the credibility issue actually come from? Is it what the government is trying to push, or is it the fact that it does seem like it's a fight between two arms which work together? Well, it's better when they work together, which is, you know, the governor and, of course, Treasury.
Well, I think we should be more open about the necessity to have a better coordination. We have already seen that during QE. Back then, it would have been better to have a fiscal expansion supporting the zero interest rate policy or even negative interest rate policy. But it goes in both ways. When you have a contraction of monetary policy, then fiscal should also pay more attention. You don't do that, you end up having a problem, in particular when you have no visibility at all whether the longer-term debt sustainability aspects are taken into account in the fiscal policy stance that is being adopted. In addition, you have the problem that if you have a current account deficit, the rest of the world is looking at this with increasingly, I would say, suspicion, hence the knock-on effects that we have seen. So I think the coordination, yes, but also, was there enough discussion ahead of these announcements? I have doubt on that.
What's your take on, you know, when you look at some of the pension funds and some of the questions that we have there on how they can also fund themselves, corporates may be asking the pension funds to fill the gap until we understand the liquidity measures. Like, is this a template for the rest of the world? Is it just, you know, chaos and messy for the UK? Christine?
Well, Francine, I think, yeah, again, the world is watching in terms of how the UK is handling this. And it's very interesting. I think at this particular juncture, there are definitely a lot of questions being asked about overall pension reform. Is it time to finally look at the LDI strategy and really scrutinize it for all the risks that were apparently hidden all this time and didn't really come to light until we saw this acute stress in the bond market? And so, you know, I think there's definitely talk of more regulation going forward. How can pension funds really diversify the types of assets that they hold in at this moment so that they can have that broader base for collateral options should we see the situation again? The problem with those sorts of ideas is that it is, in the longer term, a good thing probably, but in the shorter term, you can imagine something like that, pension funds kind of changing the composition of their holdings would probably cause more ructions in the bond market.
Great. Thank you both for joining us. William de Vilder, there, Chief Economist at BNP Paribas, and Christina Kino from our markets team joining us. Now, coming up, should we be concerned about COVID cases creeping higher as we head into winter? We discuss all of that with the co-founder of Moderna, Noubar Afeyan. That's coming up shortly, and this is Bloomberg.
everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
Let's get the Bloomberg First Word News, and I'm Leanne Gerrans. The head of the IMF says Ukraine will need at least $3 billion a month next year to finance its wartime economy, which means allies will have to give more support. At a meeting in Washington, Kristalina Georgieva also warned developments in the war could push financing needs even higher. American conspiracy theorist Alex Jones has been ordered to pay almost $1 billion in damages after repeatedly claiming that the 2012 Sandy Hook school shooting was a hoax. The Connecticut trial was the second to hold Jones financially accountable for his lies about the massacre. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Now coming up, will winter see a resurgence of COVID cases? We'll discuss the latest on vaccines and the wider backdrop for biotech with a co-founder of Moderna. That next, and this is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one.
And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
Really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Street prepares for the latest read on inflation.
Peak Fed, peak hawkishness. We're getting carried away.
The market's been right.
Are rate hikes starting to pay off?
How long is it going to take to see progress on inflation?
Fed just has a long way to go.
Instant reaction on Bloomberg Surveillance.
Inflation is still sticky. The U.S. economy is still on track.
And what it means for the Fed.
The data will tell us.
I think we're quite a ways away from a pause.
This is a Fed that will blame.
The prudent thing to do is to ease off a little bit and just have a look around.
Inflation in focus today on Bloomberg.
Blame game. UK Chancellor Kwasi Kwarteng says the BOE will be responsible if markets tank after its bond buying program ends. All eyes on CPI. Stocks fluctuate ahead of today's critical U.S. inflation print. Fed minutes show a commitment to restrictive rate hikes. Plus, the IEA warns that OPEC production cuts could fuel inflation and tip the world into a recession. Well, good morning, everyone. Welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, COVID vaccine maker Moderna rose the most in 2 months yesterday after Merck extended a partnership to try and develop a cancer vaccine. The vaccine is currently in mid-stage testing as a treatment for high-risk melanoma skin cancer. Now, like many of the COVID vaccine makers, it's been a tough year for Moderna. Before yesterday's announcements, it had lost more than half of its market value this year, but if you look at it on the longer term, it's still up. So we're now joined by Noubar Afeyan, co-founder and chairman of Moderna and chief executive and founder of Flagship Pioneering. Noubar, always great to speak to you. I mean, we want to talk about the share price, but I really want to understand your world in terms of trends. First of all, you're here, and we heard from the World Health Organization that there's a resurgence that's happening, especially in Europe, when it comes to COVID. How should we deal with COVID now?
I think we have to stay vigilant, as we've been over the last 2 years, and I think we have to use the technologies that have been developed to protect us, which in this case is the new family of bivalent vaccines.
Yeah.
These vaccines are both protective against the new strains as well as the original strain, because we don't exactly know where the virus is headed as it mutates to fight our immune system, and our immune system has to essentially mutate through technology to fight the virus. And that fight is going on. I know that some would love to believe that the pandemic is over, but as the saying goes, at least, you know, we may be done with the pandemic, but the pandemic doesn't seem to be done with us. And so we just have to stay vigilant.
So when you look at some of the bivalent, right, which I'm glad you pronounced it because I always get it wrong, when can you actually provide some of the efficacy data of how it works?
We have the bivalent vaccine that is being provided in Europe and in the UK is actually one for which we have human data, and we've provided it, and it's against one of the Omicron strains. A different strain, bivalent, that has been introduced in the US is being basically tested in the market right now because it's already available. So we are measuring vaccine efficacy, and we'll have additional data forthcoming. The reality is that no matter where we've looked in these, in humans as well as in animal trials, we've seen the kind of efficacy that one needs to be able to be protected. So I think data will come along, but definitely in field use, certainly in the strain that's in the version that's here, we have human data showing efficacy already.
If you look at the US, why was there a very slow rollout of the boosters?
I think there was a slow regulatory final approval in that they wanted a particular strain in the actual vaccine, so that delayed us a little bit. And then I think the uptake is a function of education, promotion, and people are getting mixed signals. I mean, it was bad enough that people were spreading misinformation. Now they're getting confused about whether they really need it. And I think what you're seeing in the last few days is an intensified message that people are dying as a result of not being protected. There's no question we're having 300-400 deaths a day in the U.S. That is not an acceptable level to coexist with. And so I think we have to do a much better job.
But there are more people, and actually certainly in the summer, a lot of people had COVID badly or not so badly, and so think they're protected for a long time. It's difficult, like if somebody came up to you and said, look, do I need a fourth booster? Does it depend on the age? I don't know whether it's misinformation or really vaccine fatigue out there.
I mean, I don't know. I mean, look, I don't want to seem kind of tough-minded about this, but I don't know what vaccine fatigue means any more than I know what cancer fatigue means or I know what hypertension fatigue means. It's your health. And at the end of the day, frankly, even beyond your wealth or your happiness, your health is the thing that needs protection, active, proactive protection, and that's what a vaccine does. So the notion that we should allow ourselves to get tired of protecting our health is something that I think one does by taking unnecessary risk. You could also cross the street, during ongoing traffic and say, you know what, I'm tired of waiting for these cars. Yeah. And so I just think there's a correspondence that we're missing. Somehow we're putting vaccines in a different category, and they're not. They're just a way to protect your own health. It's your own decision. But overall, the data suggests that it is much better to be protected than not.
But is that because people still get sick? So where does this, I don't know if you call it a schism, but if people don't want to get the third, fourth booster, is it because they think they'll get sick anyway and they were expecting the vaccine to do something else?
I think that it's important for people to understand that our immune system is what is the medicine here. The vaccine simply directs the immune system to do what it can do. The immune system, first of all, protects us against infection, and then once infected, it becomes therapeutic in that it actually goes after the virus and eliminates it. The therapeutic side of this, there's no evidence of that waning, and our bodies are very good at fighting back once it gets in. The vaccine helps you be put off or reduce the chance of getting infected. It does not eliminate it. So with a vaccine, you're going to have a lower chance of getting infected, and in any event, you're going to have a primed response once you get infected. Without a vaccine, you have a much higher rate of getting infected, and then once you're infected, your immune system is going to be relatively slow to respond. I think that's the kind of contrast, and between those two, the first option seems to be more protective overall.
So are people willing to get boosters more here in Europe and certainly in the UK than in the US?
It seems that the level of trust between the people and their healthcare providers, particularly with essential NHS here and elsewhere, is much higher in Europe than it is in the US. I think in the US we have kind of a confused state right now. There's depending on your zip code, depending on your education level, depending on your political party, which is remarkable affiliation, people are and are not choosing to get vaccinated. Look, this is a bit of an opportunity for the virus to find laboratories in which it can mutate, namely people who are not well protected. And so the fight is dragging on somewhat because people are making these choices, which is further allowing the virus to mutate. The virus has more mutants available now in people's bodies than it did previously because it's proliferating. Not just because sometimes we think mutating means you go from A to B. There's A to 50,000 letters now out there. I mean, it's just proliferating, and our immune system is going to have a harder and harder time if there's ample places for it to keep mutating.
But the more we vaccinate, does it change those mutations or no?
The more we vaccinate, the more our immune system goes after one aspect of the virus, then other places become vulnerabilities. So the virus is trying to escape wherever there's pressure. But in some places where there isn't kind of enough pressure, the virus can replicate before it has to be fighting the immune system. So it's if I said from 2 years ago, this is a battle between a life form that is preying on our social behavior and contact and our immune system, which is designed to fight back, but is struggling because the virus is really mutating very quickly.
Nubert, yesterday, so there was really encouraging news about cancer vaccines. Broadly, what's your approach to those and how they'll change?
Yeah. In fact, cancer vaccines are programs that we've been working on for 5-6 years, and cancer takes quite a long time. But interestingly and coincidentally, that we had worked on cancer vaccines is why we could respond so quickly to go after the virus, the COVID. And the reason is that a cancer vaccine is doing a similar thing, which is telling your immune system to fight a certain number of new sequences. in your body, namely a cancer sequence instead of a virus. So that program has been ongoing for a while, and it's been gradually collecting data. What we announced yesterday is that through our partnership with Merck, which obviously is a very large pharmaceutical company and very accomplished both in cancer and in vaccines, that they chose to expand and enlarge their collaboration on this program. And so it's very exciting to see that.
But this would be what, an incremental benefit of being vaccinated on top of the old school therapeutics to fight cancer.
Right. So let me clarify that in the case of cancer, we're talking about a therapeutic vaccine.
Yeah.
Remember I said in COVID, there's a preventative and a therapeutic version?
Yeah.
Well, in this case, you're using the therapeutic because you already have the cancer. And so the way that works is that you're showing all the different sequence variants to the immune system that your cancer represents, and the immune system is much better armed to go after it. So it's using vaccination as a therapeutic, not as a preventative.
All right, Nubar, thank you so much. We'll continue that conversation and talk a lot more about some of these cancer vaccines. In the meantime, we need to look at banks. Actually, a Bloomberg story, or just crossing the Bloomberg terminal, is Monte Paschi, the world's oldest bank, halted limit down after falling more than 13%. Now, I think they've always been quite thin on volumes, but it's falling after setting some of the terms of a capital hike at a discount. I know there was so much speculation over the last 2 or 3 years about who would buy the bank if nobody wanted the bank. We also know that there was political pressure from the Italian government for one of the big banks to absorb this. Did this not happen? Liquidity and again, trading is quite volatile on Monte Paschi, limit down 13%. Now, more coming up with Nubar Afeyan, the co-founder and chairman of Moderna. That's coming up shortly, and this is Bloomberg.
of a push have you seen from the Kishida government in terms of green funding? The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space. What do you make of Kishida's new capitalism? Well, I think his framework is reflective of the challenges that Japan society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. ASML has ordered its U.S. staff to stop servicing customers in China after the Biden administration announced tighter restrictions. The Dutch chip manufacturing equipment maker told its employees in America about the rule changes in an email. ASML has held back from selling some of its most advanced technology to China China as it tries to strike a balance between the two nations. Now, the U.S. is considering a total ban on Russian aluminium in response to the military escalation in Ukraine. Bloomberg has learned that the Biden administration is weighing a number of options, including an outright ban or a large increase in tariffs. Russia is the second only to China as a producer of aluminium, which is crucial to most heavy industries. And Hong Kong is said to be considering easing property taxes and visa restrictions as authorities seek to curb the pandemic brain drain of recent years. Bloomberg has learned Chief Executive John Lee could include the measures in his first policy address happening later this month. Hong Kong's strict pandemic measures have seen it lose ground to Singapore as an international financial hub. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now let's go back to vaccines and Moderna. We're joined by Noubar Afeyan, co-founder and chairman of Moderna, and the chief executive officer and founder of Flagship Pioneering. Noubar, thank you so much for sticking around. We were talking a little bit before about vaccines, the uptake of boosters, also the resurgence of course, COVID in the winter months. Talk to me about long COVID. So what do we know concretely? Because again, there's pockets here and there of data that the media exemplifies. What do we know about long COVID and the link to vaccines?
We are learning about long COVID, and everything we're learning is actually quite concerning, and that is that there's a persistent effect of getting COVID infection. It's not clear whether mild or strong versions of it are more correlated with it, but clearly in a significant percentage of people, some people say up to 10%, there is a persistent 6, 12 month, even beyond, fairly debilitating effect. And it happens to be in many different organs in the body. It's in the brain, it's in the liver, it's in the heart, and it's manifesting all over. Some people are now beginning to claim that that's because some amount pockets of virus are persisting. All of that is a consequence of not having an adequate immune response to get rid of the virus, which is enhanced by vaccines. So our sense is that the less people get infected, the less you're going to have long COVID. And in any case, if you can tame that infection by a strong, kind of an effective immune response, then you're going to try to reduce that risk. But we need to spend a lot of money understanding this disease, because now the virus is kind of becoming a double punch. One, through infecting you, and a second, through having a long-term effect.
But so the long COVID, are the numbers going down in long COVID in terms of percentage of when people catch COVID because of the vaccines, or no?
I don't think we know yet. I think the numbers, because we don't have a good way to diagnose it, it's a fairly loose diagnosis because people are suddenly being sick and being debilitated. So I think that we're going to learn more.
Are you talking to China about bringing a vaccine over there? We know some of your rivals have actually partners on the ground. Are you doing the same?
We have had discussions with China, and that will continue. We're prepared to support the country's fight against COVID. Obviously, as a global company, we want to make sure that's done respecting intellectual property, respecting the kind of distribution arrangements that we have, and we look forward to making that happen whenever it makes sense for them.
Which could be?
I can't forecast it because I think it's a complicated issue. Obviously, every country wants to make their own versions of vaccines, and they have internal competition as well as wanting to access external products. So I think these are complex decisions they need to make.
You have a sizable exposure here to the UK. We've seen a lot of volatility in markets, a lot of questions about the government's plans, about liquidity, even corporation tax. What's your take on the UK? Is it investable right now?
I think it's investable, particularly in the life sciences. I mean, we're very excited about the prospects of the partnership between the UK and Moderna in the first instance, which should be a rather transformative presence of a company with significant investments in clinical research here that we've committed, as well as manufacturing of vaccines. But beyond that, we're seeing several of our other companies within the Flagship ecosystem do clinical trials here. And what we're finding on the heels of that is a general facility to do this here, a regulatory entity in MHRA that seems to be very, very forward-looking and very collaborative. The NHS, which is a singular provider, is a good partner to interact with. The scientific community, whether it's in the major universities or all over the country, there is a general potential here that we perceive that is quite unique and very timely.
Does that mean that you'll put more money in the UK, and could you even buy other companies, or certainly buy talent, given the market turmoil?
We are, Flagship's based in Boston, US. I'm here for the second time over the last 6 months, largely exploring whether there are opportunities here that might lend themselves to a stronger presence, whether it's investment or collaborations or creating companies All of that is what Flagship does, the parent company here, and all of that, we think there may be opportunities here. So we're very interested in exploring and finding the right way of doing it.
Does it matter to you if corporation taxes go up or down in the UK? I mean, some argue that actually if you're a chief executive and corporation tax goes up, at least it brings a bit of stability. Others saying, well, it's just a tax on profits.
Our companies are research companies primarily, and so it takes a while for them to get to a place where they're actually thinking about corporate tax. It's one of the oddities of biotech companies is that they're primarily invested in making asset value through intellectual property and research. And so I've been less focused on that part of it any more than in the US. That doesn't really affect how we behave. More generally in other industries, I'm sure that's a major driver. But for us, we've been rather focused on human capital, scientific capital, and financial capital, and how to unlock it in the UK as it relates to the biotech sector, in which it's been very modestly involved so far. So I think there's a lot of growth here to do.
Does inflation impact you?
Inflation will impact us in many ways, but not uniquely compared to other industries. The supplies that we use to make our products are relatively kind of minor part of the value that we're creating. A lot of the value is the ultimate impact as opposed to the cost of goods. So yes, it matters. Of course, the cost of living matters. Inflation affecting that makes people less comfortable. And so that affects us, but not, again, specific to the biotech. It's a very unique research, science-based value creation sector, and so people have to think of it in that way versus one of many equivalent sectors.
Nubert, I think we started the interview also, mentioning your share price. Do you look at your share price? Are you expecting it? I mean, do you just focus on growing the company, or do you worry about the fact that over the last 12 months it hasn't been performing, I'm sure, as well as you wanted it to?
I think, I've been at this for 35 years as an entrepreneur and an executive, and in this case, chairman of Moderna. And during that time in biotech, I've seen share prices at the same time reflect the current reality, but once in a while reflect the future potential. And that defines the difference between 1 and 2 or 10x. In other words, as people start looking forward, they start realizing what the value could be, and the price starts reflecting the future as opposed to the present. Right now, I think a lot of stock prices, not ours only, reflect current concerns with inflation and uncertainty and wars and et cetera. And all of that is understandable. But at some point, that settles out, and people start saying, okay, of the remaining companies, which ones have high prospects? I think that Moderna and others that are really pioneering in new spaces will be rewarded, and shareholders will be rewarded. So at any given time, yes, I look at it, but I look at it to contextualize what it is reflecting as opposed to what the actual number is.
Nubert, thank you so much for coming in the studio today. Nubert Afeyan, the co-founder and chairman of Moderna and chief executive and founder of Flagship Pioneering. Now, we'll continue, of course, to keep you up to date, also with market news, today's key data, US CPI, and how it could impact the Fed's next move. That's coming up shortly, and this is Bloomberg.
Cryptocurrencies have been very popular. If a client came to you and said, look, I'd like some cryptocurrencies in my portfolio, what would you say?
Oh, we've actually been really deep into crypto, deep into learning about blockchain, and all of the new businesses. I would characterize us as crypto learners. We have made a series of toehold investments on behalf of our clients, both in some of the currency baskets as well as with some venture firms that are investing primarily in the crypto area. I think it has the potential to be completely game-changing, but it is still such the Wild West, and it's so uncertain. But it has the potential to completely upend everything.
For a young person who now looking at a career, would you recommend a Wall Street career today?
There are not many jobs you can have as a young individual where you're always learning.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Saba Capital Management founder Boaz Weinstein says the uncertainty that's currently gripping markets could endure for a long period. The hedge fund manager spoke to Bloomberg's Barry Ritholtz in an exclusive interview.
I'm used to, and we're all used to, sell-offs that are fairly quick, that we know even 08 was 5 or 6 months from Lehman to the lows of March 09, where at the end of it, you can kind of wonder, is there an all-clear sign? We have the Fed behind us, quantitative easing. Now we don't really know who the savior is, because at the end of all of this, we're still going to have quantitative tightening and shrinking the balance sheet. And so whereas a lot of sell-offs were just a prelude to a bull market 1 or 6 months later, this has the feeling to me like we're going to be worried about some number of these things or new things for potentially quarters and maybe even years to come.
So no capitulation yet, no flush, which gives us that all clear signal. How much of that is based on truly not knowing what the Fed's going to do, or is it we don't know which potential problem is real and which is fake news?
These things are so hard to predict. I even want to be cautious about, opining too much, because it's just such a confusing market, and there hasn't been a single thing to say, okay, this is why the market, why 20% is not enough. It should be 40. Let's take inflation. If you look at forward inflation, it's expected to come down a lot. So you could look at tomorrow's CPI print, if it comes in a tenth or below or high, and get excited about it, but the market is still telling you inflation is not going to be the problem that it is 1 year from now. Now, if a few months from now that conviction is shaken, then we're going to have a real strong sell-off. If somehow Russia, heaven forbid, becomes more asymmetric, we're going to have a real problem. And so we just don't know. We're in a fog, and we should not rely on the lessons that people learned maybe incorrectly for this environment that were good between 08 and 2022, which was the Fed is your put, don't fight the Fed, and dips should all be bought, and being short is fighting the Fed. This really does not feel like that environment, in particular because of where the central banks are versus them.
Well, that was Saba Capital Management founder Boaz Weinstein. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Katie Lyons in New York, Anna Edwards in London, and this is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
Wall Street prepares for the latest read on inflation.
Peak Fed, peak hawkishness. We're getting carried away.
The market's been right.
Are rate hikes starting to pay off?
How long is it going to take to see progress on inflation?
The Fed just has a long way to go.
Instant reaction on Bloomberg surveillance.
Inflation is still sticky.
The U.S. economy is still on track.
And what it means for the Fed.
The data will tell us.
I think we're quite a ways away from the pause.
This is a Fed that will blame.
The prudent thing to do is to ease off a little bit and just have a look around.
Inflation in focus tomorrow on Bloomberg. Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
You're having all these problems in other parts of the world. So the pressure is going to mount on the Fed.
Anybody paying attention cannot deny that we now have a set of circumstances that clearly point to a recession.
You need, hopefully, some continued signs that inflation is easing. All the inflation lead indicators are easing, but the headline inflation numbers are not.
Things can change very quickly. We've seen that. That's been the typical pattern.
Stop trying to pick this bottom. Stop trying to look for that pivot.
This is Bloomberg Surveillance, early edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Taming inflation. Investors await U.S. consumer price figures today that may determine if the Fed will deliver a fourth outsized rate hike. Downing Street is playing the blame game. Quantitative says the Bank of England will have to answer for any market turmoil that might erupt when the central bank ends its bond buying program tomorrow. And as the IEA warns that OPEC Plus cuts may tip the global economy into recession, U.S. officials fear their Russian oil price cap plan may fail. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Kaylee, we've been on Gilt Watch, it seems, for days and days now. We go to Inflation Watch stateside today.
Yep, that crucial CPI data is due in just about 3.5 hours' time, Anna, and it's going to be a big one for a lot of different reasons. Of course, you had to trade in Asia before you got those figures, but by and large, it was a down day overall. The MSCI Asia Pacific Index down by about 1%. Hong Kong, a real underperformer. Hong Kong stocks actually falling to their lowest level since 2011, and the drag created by tech stocks in particular had a lot to do with that. The Hang Seng Tech Index down about 3.4% overnight. Of course, a lot of that has to do with weakness in the semiconductor space. It's just warning after warning on demand, plus you have the new Biden administration curbs as it relates to Chinese chip companies. And overnight, Taiwan Semiconductor said it's cutting its capital expenditure target for the year by 10%. So just another warning sign for the sector. And TSMC down for a fourth day in a row overnight. Now its losses over those 4 days at about 12%. Finally, in foreign exchange, just wanted to point out that the dollar is fractionally weaker against the Japanese yen. Really one of the few exceptions out there today. But at 146.83, we are still at levels on dollar yen that we need to watch for fresh intervention from policymakers, because around this level is when Japan policymakers stepped in last go around to stem the weakness in the yuan, and of course, or the yen, excuse me. And remember, Matt, last CPI day, the yen moved about 2% weaker against the dollar within minutes. So that's going to be a currency pair to watch when that data drops at 8:30 a.m.
Yeah, absolutely have that up on my dashboard, Kaylee. I'm looking at futures that are a little bit higher today after the drops that we saw in the cash trade yesterday. We got down to 35.77. However, extremely light volume yesterday, today as well. You're going to see very light volume, or at least in futures, until the CPI print comes out. Traders are going to want to sit on their hands. The 10-year yield hovering right around where it was yesterday, 391.08 right now is the level there. This is poised also, obviously, to snap in one direction or the other, depending on what we see in terms of the CPI number. NYMEX crude coming up 59 cents to 87.86. The Saudis coming out and defending themselves against President Biden's criticism, saying they have noble ambitions to balance the oil market. And right now we're looking at Bitcoin that's off just about 0.8%, still hovering at that 19,000. I think I am going to sideline Bitcoin in my board for a few weeks until it at least moves out of the $19,000 to $20,000 range. Anna, what are you seeing in Europe?
Matt, let's have a look at where we are on the European picture. And things looking a little brighter than they did at the start of the trading day. We were pretty negative as we started out, but recovering a little bit of poise here. The CAC 40, the Xetra DAX, both up marginally. There's been a lot of focus on UK assets, UK gilts in particular in recent days. So let's get quickly to that. Of course, we are all focused on the US inflation data later on, of course. But here's the 30-year yield, and it's coming down. The 2-year yield coming down. So we've got yields coming down across the gilt curve, which is obviously a positive for global risk sentiment when we've been watching those yields climb, despite what the Bank of England has been doing. And thinking of the Bank of England, they seem to be under pressure from various market voices saying, well, maybe they'll U-turn. The Bank of England says it won't. The government in the UK under pressure. Lots of voices even within the Conservative Party saying maybe there'll be a U-turn. They keep saying that they won't. We'll see how this plays out tomorrow, the weekend, Monday. Brent crude, Matt's talked about what's going on with oil. We are up by 0.7%. It seems the IEA taking a almost similar view to the White House, suggesting that this cut in production we've seen from OPEC Plus, that is going to be something that risks pushing up oil prices, and that could weigh on the economy to the extent of causing a recession in their view. ASM International in focus. This is a part of the chips universe, of course, and the company under pressure. We heard from, of course, a player in the United States in this space. They were talking about sales being under pressure. We heard from TSMC over in Taiwan. They talked about paring back CapEx expectations. So pressures on the chip sector, it seems. Matt.
All right, so we're focused on the inflation data that we're going to get out today. It may keep the Fed on path for a big November rate hike. In fact, many economists say they're going to do 75 no matter what this print is, but what comes next is maybe more important. Fed Governor Michelle Bowman says she continues to favor large increases in interest rates to cool inflation.
If we do not see signs that inflation is moving down, my view continues to be that sizable increases in the target range for the federal funds rate should remain on the table. However, if inflation starts to decline, I believe a slower pace of rate increases would be appropriate.
Bloomberg's Danny Berger joins us now to preview today's key data. And Danny, how do we expect markets to react?
Well, markets feel very wound up at this moment, and surely the data we got yesterday in the PPI figures isn't really that reassuring. We had PPI rise yesterday, the first data point of rising after 2 consecutive months of falling. And to be clear, this wasn't about fuel prices, because even core PPI rose by about 0.4%. In terms of our expectations at the moment, economists surveyed by Bloomberg see core at 0.4%. It was at 0.6 last month. And there's this question of just how much lower does it need to go in order to get any sort of relief rally, in order to indicate that perhaps the Fed won't be as hawkish, considering we had those FOMC minutes where there was some indication of more folks talking about a two-way risk. But Matt, to get back to the first thing you asked me, because I should probably answer your question, yeah, markets are really nervous about this reading. The VIX curve, that is very inverted with a lot of volatility embedded in the front end of that curve. So for today, even Treasury volatility, that is back at the highs of the pandemic sell-off. And of course, UK bond volatility, that's contributed to this. But a day where we're getting CPI and volatility plumbing new highs for the year, it certainly feels like a nervous setup, Anna.
Yeah, it does feel like a nervous setup. And just as you were talking there, Danny, in terms of thinking about what's going on the gilt market, I mentioned it when I was talking about gilt a moment ago. The UK long bond surging, 30-year yields down 21 basis points to 4.61%. That was one of the yields we were watching go over 5 yesterday, and very much in focus as the Bank of England has today and tomorrow to do those operations. Thanks very much to Danny Berger. Let's think about how the UK is progressing here. That's what's going on in markets. The UK Chancellor, Kwasi Kwarteng, says the Bank of England will be responsible if UK markets suffer renewed volatility after its bond buying programme ends tomorrow. Bloomberg's Lizzie Burden joins us now from the Bank of England. Lizzie, it seems the Chancellor and the Governor, they're kind of playing a game of chicken, a bit of a standoff as to who's going to give any ground by the weekend.
Yeah, I know who's going to blink first. If it's Andrew Bailey, if he gives in and extends the emergency bond buying programme, rows back on his tough talk from earlier in the week when he said it was going to end tomorrow, we have to ask how much it will undermine his credibility on the monetary policy front. Will markets believe what he says he's going to do when it comes to fighting inflation? And on top of that, if the Bank of England continues buying bonds, it can't go on with quantitative tightening, at least for now, which would mean that it's prioritising financial stability over inflation fighting. And that's exactly what the chief economist, Hugh Pill, said this week the bank does not want to do. So how do we get out of this? Well, fiscally, Liz Truss has said she's not going to cut spending, which means that she would have to U-turn on tax cuts if she wants to balance the books and try to regain some market credibility. And on the Bank of England side, the only hope could be a creative solution from the Debt Management Office, which is part of the Treasury, when it comes to raising short-dated money to ease pressure on longer-term debt. This is a suggestion from strategists at HSBC. But the irony really is the Truss government throughout the summer criticised the Bank of England for not doing enough to fight inflation. Then she said that the Bank of England's independence was sacrosanct, and now the Bank of England can't do its job fighting inflation properly because it's having to put out the fire that the fiscal policy started.
All right, Bloomberg's Lizzie Burden. Thank you so much. Our wonderful markets producer, Dan Curtis, just pointing out that we have seen a 20-plus basis point move on the 30-year gilt yield in 6 of the past 15 trading days. Absolutely remarkable in the bond market. Let's turn to the commodity market now, though. The U.S. is proceeding with its plan to cap the price of oil from Russia. But some Biden administration officials are growing concerned that the plan may backfire after the OPEC-plus alliance's surprise production cut last week. That's according to people familiar with the matter. Meanwhile, Saudi Arabia rejected criticism of the cut, saying the move was based solely on its noble objectives to avoid oil market volatility. Eddie Vanderwalt of Bloomberg Markets Live joins us now for more. And Eddie, in addition to that, you have the IEA warning that the cut from OPEC Plus could put prices at a level which leads to a global recession. What is that level, and how likely is it that oil gets there, given all of these different forces at play?
Oh, wow, absolutely. You know what? I think there's so much at play in the oil market. I think, OPEC has signaled that it's quite comfortable with prices for Brent around about the $100 a barrel level, and we're a little bit below that at the moment. But, whether the world economy can sustain prices at that level, that's quite another matter. And I think what this really has told us, though, the wrangling over the oil market, is that supplies are quite tight. And I think if we see demand picking up, oil could shoot significantly higher because there doesn't seem to be that much spare capacity in OPEC. And I think the U.S. position is making clear that this is becoming an election issue for Biden. So I think there's the oil market's going to be at the center of conversation in the next few months.
Yeah, absolutely, politically and economically. Eddie, thank you very much. Eddie Vanderwalt of Bloomberg Markets Live. Elsewhere in commodities, we should bring you up to date with what is happening. And the U.S. is considering a total ban on Russian aluminium in response to the military escalation in Ukraine. Aluminum surged after Bloomberg reported the Biden administration is weighing a number of options, including an outright ban or a large increase in tariffs. Russia is second only to China as a producer of the metal, which is crucial to most heavy industries. Matt?
Yeah, we'll be paying very close attention to that. We are watching, of course, what's going on in Brussels, where NATO defense chiefs are gathering for a second day of meetings today. They will discuss increased security of critical infrastructure and are expected to offer more air defense capabilities for Ukraine in the face of Ukraine's stepped-up missile strikes. Bloomberg's Maria Tadeo joins us now with the latest. So, Maria, what do we know?
Yes, Matt, and the message from the NATO Secretary General this morning is that the alliance will stand by Ukraine, quote, for as long as it takes. It will increase support for the country and provide the air defense systems. Remember, this was the main ask from the Ukrainians going into this meeting. Of course, the question always when it comes to NATO is who provides who, but also just how quickly can this get to the front line. The other big issue, which to me I'd argue is equally important for some European countries as part of NATO, is what happens to some of the critical infrastructure, so the pipelines, the cables, the underwater systems, the grid that they worry could be compromised in a form of hybrid war going into the winter. Well, the NATO Secretary General says if it is maliciously compromised, it will trigger a, quote, united and determined response from the alliance. Now, the question, and this is key, is could it trigger Article 5? There's some strategic ambiguity from NATO this morning.
All right, Bloomberg's Maria Tadeo reporting from Brussels. Thank you so much. Now let's get back to the equity market and take a look at some stocks moving in pre-market trading here in the U.S. Anna was just running us through what's going on with aluminum prices, and that is having a positive read-through to aluminum makers here in the U.S. like Alcoa. The stock was up about 5% yesterday on that original news around the Biden administration weighing those moves, and just a little bit more of a gain coming this morning, up about 0.4%. Another stock that is gaining is Delta Airlines. This is interesting because it does report this morning. It just hasn't reported yet, and yet ahead of those results, the stock is up 2.6%. Maybe traders have a little bit of confidence after the positive pre-report we got from American Airlines earlier this week, so look out for those figures in just a couple of hours. But two stocks moving to the downside would be U.S. casino operators that have big revenue weighting toward Macau in particular. There is concern around the COVID zero strategy in China persisting even after the Party Congress wraps up in a week or so. So you have Las Vegas Sands starting to gain a little more traction in the pre-market, but down hard for Wynn Resorts, down about 2% before the bell, Anna.
Yeah, Kaylee, maybe we'll get to focus more on China tomorrow as we work our way towards those important meetings taking place, and they start this weekend. Coming up on the program, we'll speak to Charlotte Ryland, co-head of investments at CCLA Investment Management. We'll get her perspective on what's going on with UK gilts. I feel I've said whipsaw too many times this week, very much overused, but very much appropriate as well, as we watch the 30-year yield really dropping today. We'll also talk US CPI with Charlotte and with Steve Blitz, TS Lombard, chief US economist. We'll get his perspective on exactly what to watch for. Plus, down to the wire, the fate of the Democrats' agenda comes down to a handful of key U.S. Senate races. Today's Big Take explores 3 plausible outcomes. Read more on Bloomberg.com or on the Bloomberg terminal. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Wall Street prepares for the latest read on inflation.
Peak Fed, peak hawkishness. We're getting carried away.
The market's been right.
Are rate hikes starting to pay off?
How long is it going to take to see progress on inflation?
Fed just has a long way to go.
Instant reaction on Bloomberg Surveillance.
Inflation is still sticky.
The U.S. economy is still on track.
And what it means for the Fed.
The data will tell us.
I think we're quite a ways away from a pause.
This is a Fed that will blink.
The prudent thing to do is to ease off a little bit and just have a look around.
Inflation in focus today on Bloomberg.
Welcome back to Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons here in New York. Anna Edwards with us out of London. Now, I'm showing a chart. For those of you listening on radio, normally this would be a big move for a year or even multiple years, but it's less than a month. This is UK gilts. These are the long 30-year gilts, and we've gone from 360 basically to 500 in less than a month. Today we've gone down another 20 basis points in yield, and each day we're up or down 20 or more basis points. It's pretty insane. Joining us right now is Simon White, Bloomberg macro strategist out of London. Simon, what do you make of this incredible volatility? It's not just gilts, right? We've seen this in the treasury market as well.
Yeah, I mean, liquidity across bond markets is kind of fallen through the floor. You know, the treasury market is supposed to be the most liquid market in the world, has very low liquidity right now, and obviously the UK situation is kind of even more extreme. So the moves you're getting in UK gilts are you know, they're big moves, and they obviously have their own kind of unique problems in the UK, but really this is something that's more kind of broadly systemic, I think, in the current environment.
Simon, good morning. And what had been broadly systemic had been rate rises. Today we see gilts, the yield on gilts coming down across the curve, a little bit, you know, less tension in the markets for some reason. What are we watching for in the tenders that take place with the Bank of England today and tomorrow? They did more yesterday than they've done at any point during this special provision that they're doing for the pension sector. They did more yesterday than at any time, but they haven't got to the maximum that they can do in a day. What do we watch for here?
Well, I think they've laid the gauntlet. I mean, this is very interesting because it's the first time really in a long time we've had the central bank pushing back against the market. For many, many years, the market's kind of got used to kind of throwing its toys out the pram and it getting what it wants. Central banks having bigger kind of facilities and easing and lowering rates and all the rest of it. This is really the first time I can remember where the central bank has pushed back. So, you know, if the LDI funds can get what they need to get done by Friday, then, and we get into next week, and there's been no major volatility, and I think that's quite interesting.
And it's hard to know, isn't it, whether they can, because I was talking to one of our colleagues earlier who was saying there's just so much leverage and nobody really knows how much.
Nobody really knows, but on the other hand, you know, that some of these, the people who are running these funds must have some idea what they need to do.
Yeah, they do, yes. Kaylee?
Well, Simon, speaking of central banks and markets being in contention, the Federal Reserve continues to say don't bet on hikes in cuts in 2023. The market keeps betting on cuts in 2023. How could the CPI data today inform or change that narrative?
Yeah, I mean, the rates market is basically front-running this pivot, if you like, this sort of 2023 sort of inversion in the curve. So really the risks are the other way. So if we do get a higher print today, I think that could create some fireworks. I think 10-year yield could easily go through 4%. I think the curve will invert more. But really the indicators are that's not going to happen. If you look at all the sort of medium-term indicators of inflation, for instance, survey expectations are falling. Margins, which have been a huge driver of this inflation that we've got, have also been falling a lot, like things like used car dealers, freight distribution, all these sort of things. So the thing to watch really is the transport component. That's been really taking a lot out of inflation over the last few months, so that should continue to do so, as long as the shelter and food components don't rise too much to mitigate that. But general trend is heading lower for now.
Okay, that sounds hopeful. Simon, thank you very much. Bloomberg Simon White joining us there. And for more market analysis, check out MLIV Go. That is the function to use. If you want to find the Markets Live blog, there's plenty on there about UK gilts. There'll be plenty on there about US CPI as well. This is Bloomberg.
young person who now is looking at a career, would you recommend a Wall Street career today?
There are not many jobs you can have as a young individual where you're always learning.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
In a $7 trillion industry, there's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg.
I'm Kaylee Lines.
And I'm Damian Sassower. Join us each week on our brand new show, The Lineup. If you're betting on the Mets, it's a pretty good return.
We'll cover the latest trends in sports betting, the hottest matchups, shifting spreads, and the data you can't find anywhere else. It is crazy how much the money line has changed from the preseason to now.
Plus, expert insights from special guests.
The Eagles got a gem on their hands. I hate to say it because they're in the NFC East with the Giants.
Odds are it'll be your favorite way to stay in the game.
Catch The Lineup Fridays and Saturdays only on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. In Ukraine, the Kyiv region was struck by Iranian-made drones today as air raid sirens rang out across much of the country for a fourth morning. Airstrikes also continued in the south. Meanwhile, allies in Brussels for a NATO defense ministers meeting are expected to offer more air defense capabilities for Ukraine in the face of Russia's stepped-up missile strikes. Meanwhile, the head of the IMF says Ukraine will need at least $3 billion a month next year to finance its wartime economy, which means allies will have to give more support. At a meeting in Washington, Kristalina Georgieva also warned developments in the war could push financing needs even higher. And American conspiracy theorist Alex Jones has been ordered to pay almost $1 billion in damages after repeatedly claiming the 2012 Sandy Hook school shooting was a hoax. The Connecticut trial was the second to hold Jones financially accountable for his lies about the massacre. Coming up, we'll get back to the markets ahead of today's crucial CPI data coming in just about 3 hours. Charlotte Ryan, CCLA Investment Management Co-Head of Investments, joins us next. This is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund just typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, you ideally, you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different, Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Taming inflation, investors await U.S. consumer price figures today that may determine if the Fed will deliver a fourth straight outsized rate hike. Downing Street is playing the blame game. Kwasi Kwarteng says the BOE will have to answer for any market turmoil that might erupt when the central bank ends its bond buying program tomorrow. And as the IEA warns that OPEC Plus cuts may tip the global economy into recession, U.S. officials fear their Russian oil price cap plan may fail. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. And of course, Matt, we're all waiting for the CPI print later on today. Any sense that we're peaking? Any sense that rent can deliver any relief?
Yeah, absolutely. We'll be tuned in, glued to the screen for that release. Nonetheless, we don't see, or maybe because of that, we don't see a lot of action in the markets right now. Futures are up about 0.5%, but volume's very low, and volume in the cash market was very low yesterday as well. We came down to 35.77 at the close yesterday, and we could see a little bit of a bounce from that. But I think, you know, a lot of traders are still expecting 75 basis points. So the number that we get today is going to determine what happens after the November meeting. Nonetheless, you could see big gyrations in stocks, in treasuries. Right now, we're holding pretty steady at 390. It's 389.65. Even NYMEX crude really isn't moving very much. It's only up 20 cents with all the back and forth between the president, who has said there will be consequences for Saudi Arabia in terms of the production cut we got from the last OPEC meeting. Saudi Arabia responding, saying they have, you know, a noble work to do in terms of keeping the oil market balanced, and it wasn't about siding with Russia. And then not much movement in Bitcoin. Of course, there doesn't seem ever to be any movement in Bitcoin, at least the last few months. Right now, we're down just 0.8%, but still holding over the $19,000 range. And Kaylee, what do you see in terms of the U.S. market?
Well, obviously, we have CPI in focus today, but we also are going to be getting some earnings this morning, including from Delta Airlines, really the first official report we'll get from the airline sector here in the U.S. And ahead of those results, the shares are higher by about 2%. There may be some positive read-through from the fact that the pre-report we got from American earlier this week was fairly strong. Elsewhere in the travel sector, though, not as much luck for Carnival Cruise Lines. It's down about 1.25% before the bell. And then two other stocks are really a sector worth mentioning this morning. Casino operators that are listed here in the U.S. but have big businesses in Macau. There is a lot of concern in Macau, not just about a weaker Golden Week holiday that just wrapped up a few days ago, but also around the COVID zero policy, perhaps persisting even after the Party Congress is over. So as a result, MGM, Wynn Resorts, each down a little more than 2% before the bell, Anna.
Kaylee, European equity markets then kind of in a holding pattern, waiting for the US CPI data. We sense also waiting for the latest developments around the UK gilt story. And let's deal with both of those. So this is where we are in the holding pattern, up by just 0.25% on European stocks this morning. The 30-year yield then dropping substantially, as we've talked about a number of times already on this programme. We seem to see a bit of a standoff between the Treasury and the Bank of England, both under pressure to change course, and both of them insisting that they won't change course as we head towards the end of the bond buying programme. That comes tomorrow. We've got today and tomorrow to deal with the bond market, to deal with the long end of the gilt market. That programme from the Bank of England comes to an end tomorrow. That's what the BOE says. And so we're all going to be watching for the detail around how much of the gilt market the Bank of England is buying. They bought more than they have on any day so far in yesterday's session. Are they buying a lot today? Is that part of the reason we're seeing so much movement in the 30-year? Brent crude is up by 0.3%. The IEA giving us their view, saying that they also think that that cut in production from OPEC Plus could risk pushing up oil prices and therefore weighing on the global demand story and causing a recession. And ASM International, this is a global story around chips, of course. There's been the tension between China and the United States. And then we got an update from a US player, of course, which was talking about revenue difficulties. We also heard from TSMC. They've pulled back their estimates around CapEx. So all of that, Kaylee, adding up to further gloom for the chip sector.
The gloom just keeps coming. It seems like a tidal wave of bad news in that sector in particular. And frankly, it seems like a tidal wave of news always in the UK as well. So let's continue that story discussion. Joining us is Charlotte Ryan, CCLA Investment Management Co-Head of Investments. Charlotte, every day it seems there is more volatility. We have seen 6 out of 15 trading days with a move of 20-plus basis points on the 30-year gilt yield. How confident can you feel about investing in any UK asset right now?
I mean, I think it'd be a little extreme to write off the entirety of the UK just because we're getting gyrations in the bond market. I mean, you know, clearly there's been some liquidity issues within the gilt market. There's, you know, the huge moves that we've seen in response to the mini budget have clearly caused some issues within the pension funds, and the Bank of England was trying to calm that situation down. But I think it's, you know, certainly the yields that we're getting to now within the UK, certainly 30-year pushing through 5%, is getting to a point where actually you think that's probably far enough. And certainly the market's pricing in, 6% as a sort of terminal interest rate in the UK, which I think is a pretty high level to be pricing in. So for the first time in probably years, actually, you're probably getting to a point where actually the bond market is looking a bit more interesting and actually showing a little bit more value.
Charlotte, I wonder, it's probably a little early to learn lessons from this, given that we're still very much, it seems, in the depths of this crisis. But we had a question in from one of our viewers, and it might be useful for international viewers to understand this, who was asking about why pension funds are allowed to run leveraged bond positions. And I know this is particularly related to defined benefit schemes or DB schemes, and it's quite complicated. We've heard from the regulator talking about how pension funds must learn lessons from this cash crunch. We also know for those schemes that higher interest rates can be positive for them longer term. It's in the short term that they have issues. I mean, where do we think we turn for insights into why we've got to this position, Charlotte?
Yeah, I mean, I think if the defined benefit schemes, which is the ones we're talking about here, are basically in runoff. That's not something which is a growing part of the pension scheme anymore. And clearly what they've been doing is trying to, you know, put in something in place which is hedging their liabilities. And what's upset them is the fact not that the bond market yields are moving up, but that they've moved up so rapidly. And I think it's that volatility and having to cover, you know, some of that collateral that has caused the issues. So, in terms of sort of, you know, pension funds going forward, I suppose, you know, it's a question of making. I think the funding is still there behind them, the liquidity is still there behind them, and longer term, if you've got higher bond yields, yes, that means the liabilities are worth less effectively. So it's a short-term issue, and hopefully something that the Bank of England can sort out.
What are the spillovers that you're concerned about here, Charlotte? Because from an international perspective, some trading desks telling Bloomberg that they've seen pressure on US corporate debt, for example. They've seen pressure on CLOs in Europe. There have been all kinds of areas that they've seen pressure and rising yields as a result of what's going on here in the UK and the spillovers into those markets. And now I was reading also on the Bloomberg, there's concern around other areas of the shadow banking system in the UK, whether that's private equity or fintech. Where do we look next for the next shoe to drop, I suppose?
Yeah, Yeah, and I think that is the big question. It isn't just a UK problem because the direction in upwards in interest rates is true in the US, it's true in Europe as well. And so we've had, an era of very cheap money. And so I'm trying to work out who is going to be most vulnerable to that. It is going to be quite hard. I think probably it isn't the banks this time because they've been so well recapitalized after the last crisis. I think if you've got businesses which are holding a lot of leverage, where that leverage needs to be refinanced in the short term, that could be a problem. So I think you need to be sort of slightly careful in which equities you're owning, making sure that they actually have those decent balance sheets. But if, certainly in the sort of the private markets, we don't have a great deal of visibility of what's been going on there. And so, potentially that could be where some of these problems emerge, but it's very difficult from the outside to actually sort of pinpoint where.
Yeah, well, we wouldn't have known how much leverage these pension funds are holding either if we hadn't had this little hiccup here. Charlotte, it's not just about the UK, right? Yesterday, the U.S. Treasury Secretary, Janet Yellen, said, and I quote, "We are worried about a loss of adequate liquidity in the market," talking about the Treasury market. How insane is that?
I know. It's quite surprising, actually, how illiquid some of these bond markets are. And I suppose, one of the big buyers that we've had in the market for the last few years has been central banks, and they're stepping back. So, that's a concern. So, and if you move into quantitative tightening, we don't really know what the implications of that will be because we've never really seen anybody do it before. So I think it's going to be something, again, adding to that volatility in markets.
Is it, higher rates, the higher rates that were already pretty much guaranteed from the Fed and the higher rates that we're seeing in these markets, are they going to make funding costs so expensive that it impounds or compounds, I should say, the depth of the recession we're looking at?
Yeah, I think it adds on to that sort of margin pressure that you're likely to see in companies. Yes, their funding costs are going to be going up. Mortgage rates moving through 6% in the US. If you're a corporate, you might have been, borrowing at extremely cheap levels, particularly at the junk end of the market. Now that's no longer true. You're going to be struggling to get that funding. So adding on to that, the energy costs which have moved up, and some of the various other sort of costs that have been moving up, wages, of course, looking pretty tight still. So I think it's going to be a difficult picture in terms of margins. And I'm not sure that's entirely in numbers yet, which is why we're, staying pretty cautious on the equity market overall.
Charlotte, thanks very much. Charlotte Ryland joining us there from CCLA. Coming up on the programme, we will turn full force towards the US CPI print. We'll talk to Steve Blitz, TS Lombard, chief US economist. He'll give us his perspective on the data to come. This is Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China. But African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window. They have thorns on them.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
So by moving at an aggressive but not an overwhelming pace, it allows us to get the funds rate up, to signal our commitment to keeping inflation in check and bringing it back down to 2%. But it also gives us some time to see how the economy is unfolding.
Neil Kashkari there, president of the Minneapolis Fed, speaking yesterday. Joining us to talk more about the Fed and inflation, the economy, is Steve Blitz. He is chief U.S. economist at TS Lombard. Steve, thanks so much for coming into the studio with me and Kaylee bright and early. What do you expect, first off, from the inflation print today? And how important is it in deciding the Fed's moves going forward?
Well, the second part's easier to answer than the first, right? So not very much, right? Because the Fed always deals in 3-month moving averages, right? So it's going to look at this, and if it's a great print, they'll say, okay, this is good news, but we need to see this for another 2 months before we actually believe this is a trend. And secondly, most people, and then also, I think, especially when you read through the minutes and you listen to what they're saying, the issue for them isn't inflation per se in terms of solving this problem. The issue is the imbalance in the labor market, right? And that, you know, that's 3.5% unemployment rate and 288,000 jobs per month, which you think this is a great thing, but from the Fed's perspective, this is the root of the issue, and that you're not really going to get inflation driving down towards 2% until the unemployment rate gets up to 4.5%.
So 4.5 is where they want to go in order to control inflation. Those are their two mandates, right? Price stability and jobs. They have made it pretty clear that they don't mind if they break some things along the way, right? The market previously expected a pivot and even a cut, but now everyone we've talked to has laid out the fact that they're going to raise rates to a relatively high level, 4.5%, 5%, and hold there for a long time.
Yeah, well, first of all, you can't get from 3.5% to 4.5% unemployment without breaking something, right? Yeah. You just don't suddenly wake up and just drift to 4.5%. So yeah, something has to occur to get there. They're living on what they think is what I like to call their 4.5% solution, right? So if they get 4.5% or higher, the labor market is now working with them in terms of putting downward pressure on inflation. At a 4.5% or so funds rate, right, they're like in line with that against inflation, with inflation running between 4 and 4.5%. Now they've got unemployment above inflation, and they now have unemployment working with them, and then they could sit there in that position, right, and now they feel they've got all their stars aligned for inflation to go down, and then they'll follow, the funds rate will then follow inflation down, staying like, say, 25, 50 basis points above the inflation rate. But as my grandmother used to say, man plans, God laughs.
Yeah.
So
well, and sometimes markets laugh too. The BOE also would like to fight inflation, yet because of concerns around financial stability, they're running into some conflict in the UK. And you could make the argument as well that the Fed ultimately is going to have to make a choice between financial stability and the inflation fight. Do you really believe the inflation fight wins when it comes down to it?
Yes and no. I think in the near term, the answer is yes. But that's also one of the reasons why you keep getting these sort of hawkish and dovish kind of comments from the Fed. The avenue to weaker growth is the equity market. But they don't want the equity market to crash. They don't want the bond market to crash. So, because then that puts them in the position where the BOE is right now. Yeah. We're having to save markets so that markets can function with not unemployment, but unemployment too low, but more importantly, inflation too high. So that's one of the reasons they're guiding. There's an awful lot of massaging and politics that's going on in a lot of these statements. But when you read through it, they're very clear in terms of what they want to do and where they have to go. But yeah, they do not want to create financial market disruption.
Steve, it's Anna in London. Good to see you. So in terms of the unemployment story, I know that today we're waiting for the inflation picture, and we don't lose sight of that. But you've made unemployment a key part of the Fed narrative here. You've talked about that. Give us the long view here and your expertise on what is driving the labor market and the tightness, because you've pointed out that we're in the middle of some big socioeconomic changes post-COVID, and that we need to reflect that. We can't necessarily expect normalization back to how things were.
Right. So just that would take, an hour show.
It's a thesis, yeah.
But I think to keep it just on the unemployment, the problem with the unemployment market, not the problem with the change in the unemployment market, is that the over 55 group, that employment population ratio dropped and was far below where it was in 2019, and those people aren't going back to work. Gen Z is coming into the marketplace now, in the labor market, but that's a smaller generation than the millennials. So you've got a lot of people left, which is really baby boomers and the older end of Gen X. They're leaving the market. It's a big number. Less are coming in. And in terms of importing workers through like H-1B visa, you know, Trump and everyone, they kind of blew that up during his administration. And without making a political argument, good, bad, or indifferent, the fact is it occurred.
And it hasn't been unlocked.
And it hasn't been unlocked, and it's very difficult, as you guys probably know, trying to bring an employee from somewhere around the world into working for you guys in New York is extraordinarily difficult now. So you've shifted the supply of labor. So you've got two choices then. Either you unlock the supply of labor, which is a longer-term issue, right? And that's something like Brainerd and everybody else is going to argue in terms of that's the ultimate solution to the employment issue. But in the near term, the way you break that is that you have to reduce the demand for labor.
Right.
Fed thinks it's 4.5%. Summers, Blanchard, others, myself included, think it's probably closer to 5.5%, where you bring that world back into balance.
So talking of how things are different post-COVID, the labor market, yes, but also what about just inflation? I mean, is a 2% inflation target no longer appropriate for the world we live in now?
Yes, and I think the Fed's going to get there, right? They can't get there now. They would just totally destroy their credibility if they said, what was so special about 2% anyway? Let's make 3% the target. So they put 2%.
Why that? I prefer 1% or none.
Or well, that's you. But I think what they'll say is that 3% is probably the better number, right? I'm the price to get back, to understand how we got to 2%. We had this incredible surge globally of supply of productive capacity, which was greater than the increase in demand because of the low income in China, Russia, Eastern Europe, and all that. And so you had 25 years of zero growth in CPI goods, ex food and energy.
And now that's flipped on its head.
And now it's flipped on its head, and that's changed. And an awful lot because of economic security issues, what looks like a permanent upward shift in the cost of energy in Europe, all these things are bringing a lot of industry back to the U.S., which exacerbates the labor problem, because now you're looking not for waiters and busboys, you're looking for people who can work in manufacturing facilities.
Steve, thank you very much. We appreciate your time. Steve Blitz of TS Lombard, thank you very much for joining us. Coming up, we will be hearing from the IMF Managing Director, Kristalina Georgieva, live from the annual meetings in D.C. That's at 8:30 a.m. in New York, 1:30 p.m. in London. This is Bloomberg.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
careful. I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry crossed $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade. At that point, I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close, weekdays on Bloomberg.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Matt Miller in New York and Anna Edwards in London. Now let's take a quick look at what is coming up today. Italy's newly elected parliament convenes for the first time since the election. G20 finance ministers and central bankers will be meeting in Washington again. The House committee is investigating the January 6th assault on the U.S. Capitol and holding what its chairman says may be its final televised hearing at 1 p.m. New York time. But of course, today's main event, the U.S. CPI data at 8:30 a.m. Eastern. Matt, just about 2.5 hours to go.
Yeah, definitely be watching for that U.S. inflation print. It's really important, obviously, to asset prices today. It is set to show core inflation returning to a 4-decade high, underscoring the broad and elevated price pressures confronting the Fed. Our markets editor Valerie Teitel is in London to discuss why today might all be about the stickiest component of them. This is one you've really been focused on, Valerie, rental prices.
Yeah, that's true, Matt. Now, the Fed speak of late has made it very, very clear that the Fed is not going to temper their hikes until they're positive that core CPI has turned a corner and is headed down. Now, what is the main driver of core CPI? At the moment, it's rent. By last month's print, it now contributes up to 40% of core CPI, and even headline, it contributes over 30%. Now, this is a bit worrying because it's yet to peak, and we know that because it's so sticky, as soon as we do hit a peak, we basically draw a straight line out 4 quarters to see when it might turn a corner. Now, there's another reason why this is worrying, and I have a graphic to show you here, is that there is a debate about the validity of the Bureau of Labor Statistics data. Now, people are looking more and more at the private alternative measures of rental inflation, which just focus specifically on new rentals, which has skyrocketed over the BLS statistics. But most importantly, it has shown a peak. Now, because the Bureau of Labor Statistics was so concerned about this debate, they released a working paper, you can find it on their website, basically backing their methodology, saying, hey, we can back out this new tenant inflation data from our data set, but it comes at a 4-quarter lag, meaning we might see another a few more higher prints month on month until we start to steady out. Now, I'll leave you with this, Anna. Fed Williams last week compared inflation to peeling an onion. The first layer is commodities. The second is we eventually hit core inflation.
Okay. Excellent. There you go. So there are many layers to the onion is the point. And Valerie Teitel with the nice metaphor. I think we did it justice. We'll get back to that one after we get the inflation print, perhaps. This is Bloomberg.
what do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, you know, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is not just a UK issue. This bond route is going global.
It's a big warning sign and it's a red flag, and we should not just assume just because we're in the United States we're immune from it.
The pressure is going to mount on the Fed.
We do think that there's a risk of a financial event that's going to feed into policy decisions.
This is the most challenging fundamental backdrop we've had in 40 years.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
What a 24 hours we've got for you to close out the week. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Equity futures positive 0.5%. It is CPI Thursday, and that number a couple of hours away, Lisa.
And just to sort of set up how significant this could potentially be, the last time we got the CPI print on September 13th, we saw a 4.3% decline in the S&P, the greatest decline going back to June 2020, to give you a sense of how significant of a reset this number could be.
Fold in the Federal Reserve minutes of yesterday. Yes. The risk of doing too little outweighs the risk of doing too much. Do you think that decision, that assessment, is coming a little bit closer into balance as we close out this year?
There is more dissent around the margins, that there is this feeling that perhaps they're getting closer to a restrictive stance and they can start to worry about the financial stability concerns. It was interesting that they didn't give a nod. A nod is basically a generous way of saying they basically touched on the fact that the rest of the world existed in those minutes. And is that the beginning of perhaps a little bit more of a balance with respect to these risks?
Did you see the latest news out of the UK? The Chancellor now saying any volatility after tomorrow is basically over to the governor. Yes. That's the word to the Chancellor.
He basically said it's your fault. If there's a problem, this is your responsibility, not ours. And, you know, we're going to keep doing what we're going to do. Now, what about you?
It's a matter for the governor.
What I find interesting is that he's saying this from Washington, D.C., because they're down for the IMF meetings, all of them, IMF coming out and absolutely eviscerating them and saying their budget is terrible. And all central bankers are saying right now it's fiscal policymakers' responsibility to really get their world in order. And fiscal policymakers are saying, no, it's you guys.
It's a matter for the governor.
You guys figure it out.
We'll catch up with TK in just a moment down in Washington, D.C. Looking forward to doing that. Equity futures right now, positive 0.4% on the S&P 500. As we go into the inflation day number, you have got a 6-day losing streak on the S&P. Can we break that? At the moment, we're snapping it for now. Yields unchanged on a 10-year, 389.65 on 10s, and euro just about positive, stronger. Euro dollar 97.25, Lisa, firmer by 0.2%.
And just to put that into perspective, if we get a 7th consecutive decline on the S&P 500, that will be the worst streak going back to February 2020. This is what Deutsche Bank's Jim Reed pointed out this morning. Very much in focus with respect to that loss or potential ongoing going streak. 8:30 a.m., we do get that key CPI print for the month of September. I'm really watching core inflation. This is going to be stripping out food, stripping out energy. Can we get a new high, the highest levels that we've seen going back decades? What will that mean for a Federal Reserve that might be seeing some relief on the headline number with respect to energy, but not when it comes to rents, not when it comes to other basic expenses that people are paying every day? Today, there is an absolute mess in Washington, D.C. Tom will go through it, but what isn't happening down there? There's the IIF, the IMF, a G20 meeting. I am particularly interested in a couple of interviews done at the IIF with JP Morgan CEO and Chair Jamie Dimon and Citigroup Chair John Dugan. What kind of sense of systemic risk are they going to really highlight, of a sense of not functioning in certain markets like treasuries, for example, at least on the margins? And at 1 p.m., we do get another auction. U.S. is selling $18 billion of 30-year bonds. Yesterday's 10-year auction was not great. And you saw them sold at yields that were the highest, John, going back to 2009. And still there was not blockbuster demand. Do you have the same kind of dislocation on the 30-year front?
As the central banks step away, we've got to ask a broader question. Who's stepping in?
Exactly.
Where does the buying come from and what price? We're finally returning to price discovery without the distortions of these guys. And we're not there yet. This is part of the journey, but it's certainly a very volatile one.
And it goes to the point that you've made. What happens when the risk is in the risk-free asset? How much does that change international markets?
It gets very difficult to price actual risk assets. And that's been the problem of the last several months, arguably the whole year. Tom Keene is down in Washington, D.C. for us right now. TK, it's CPI Thursday.
It's CPI Thursday, John, and in 15 plus years of coming to these meetings, the April meetings and these annual October meetings, there's no question today, John, that CPI, United States inflation, is front and center for every single attendee of the IIF, the World Bank, and the IMF. Today's an important day for us. We'll be speaking with the managing director. She has a full plate of risk and financial instability to discuss.
Looking forward to the conversation, Tom. We're going to catch up with you in the next hour again. Looking forward to that too. What a lineup down in D.C. and what a time for these conversations, Lisa.
It's such a difficult time. The message is really interesting from a lot of policymakers, central bankers, who are saying, hey, fiscal guys, it's on you. And the fiscal guys coming out and saying, no, we're going to punt. And how much can this really go on? Somebody has to blink. Who will it be?
Joining us now, I'm pleased to say, is Peter Chantwell, the head of global macro strategies trading at Mizuho. Peter, fantastic to catch up with you, sir. I've wanted to catch up for a number of weeks now. Can you help us identify the spillover from what's happening in the UK out to international markets, perhaps even US credit?
Yep, absolutely. I mean, the events in the UK have meant that there has been selling of global risk assets. If it's liquid, it's been sold. And that's the transmission that we've seen. And that's why, on Bank of England buyback stories, it has a material impact across US risk assets and risk assets in other jurisdictions. What we haven't seen yet is much by way of fear of replication of the issue that we've got with UK LDI in the rising real rates environment, and that taking place in the US or in Europe. So I don't think that those equivalent investors are anywhere near as large as the UK LDI in terms of their proportion of the domestic market. But I think the mechanisms are the same. I think as we go into the rising real rate environment, that generally the pension fund community is going to be selling assets. They have an excess, a surplus of assets at the moment. As real rates go up, their liabilities go down, and that is going to continue this move, albeit in a much more orderly manner in non-sterling markets.
Peter, how much is this the tip of the iceberg, and how much is this a note of leverage that's been mostly beaten out at a time of incredible turmoil, both on the fiscal and monetary policy of the UK?
Yeah, it is all about leverage. In hindsight, really, this is something that I suspect the Bank of England has been considering when it's been trying to set its monetary policy, because it has always puzzled me as to why their inflation forecast was way below the sort of inflation forecast that I was using internally, and basically why they're having this dovish slant to their monetary policy. I think it's come to bite them now, because they've stored up all of this inflation risk premium, which has eventually meant that given this fiscal surprise from the government, then caused the big blow up in gilts that we're all now experts on. I think that what we've had in the UK really is symptomatic of what is happening elsewhere, but it's just in the UK, the cost of liquidity is that bit more greater, so the market is that bit more fragile than dollars and euros, so the move has been really exaggerated.
Yesterday,
but it's not finished, I don't believe.
Well, and yesterday, something interesting happened. Initially, there was a huge sell-off in gilts, and you saw 30-year yields climb to new highs of this particular economic cycle. And then suddenly it reversed, and it came after some sense that the Bank of England was buying with no bids rejected, this feeling that finally they were going to come in basically unbarred by any particular parameters in terms of staving off some of the distress. How much is that going to be what they have to do? Basically going against their mandate of removing quantitative easing and go back to it in order to get financial stability over the longer term, because as you said, they are not all the way done with these LDI issues.
I don't think I don't think that they're a price insensitive buyer. Their operational procedures tell us exactly what the price level that they would buy at. It's yesterday's trade went close. And at the moment, with the rally that we've had in gilts today, it should mean that if the market stays where it is, then between 215 and 245, they'll be buying about zero. And then the market could well reverse off that. So it's a very, very technical market, but I think we're still going to be moving away from this financial intervention towards asset sales from the Bank of England. I think perhaps the more important question is, are asset sales of long maturity gilts, so 20-year plus, are they feasible in the environment where the LDI community is still somewhat fragile? I suspect that they're not, and so we may see the quantitative tightening and asset selling program of the Bank of England modified slightly to reflect that. But I feel really strongly that the only way that these inflation problems that the UK has, and basically the twin deficits, we're not the US dollar, is going to be resolved is with much higher real rates. I think real rates need to get up to about 2.5%, and 10-year UK real rates is in the low 1% at the moment. It's got to be above where the dollar market is.
Pete, just to be clear here, I just want to jump in because what you just said is really important. You think QT still starts at the end of this month. Now, I understand you think it's recalibrated, perhaps with shorter dated gilts, but do you also think this gilt market operation ends tomorrow? And if it does, can you tell me what the price action is going to look like? I guess that's the $1 trillion question between tomorrow and then.
Well, I can't see it being worked out without there being more volatility in the market. If this market behaviour continues where the Bank of England is there with a known price level that they're willing to buy at, then I suspect these gyrations are going to be quick today and tomorrow, and we could be quite underwhelmed with how much they buy today. But then come Monday, with that support no longer there, I think the market will struggle to find a clearing level, and we could well have real yields going up higher. Now the question is, has the LDI community delevered and liquidated enough for them to be able to withstand margin calls? Cover ratios have gone up. They now have a surplus of assets, which is great. I suspect that they could well be rebalanced. And what we can now move into is further sell-off of gilts. I think the 10-year nominal yield probably gets to 5% without it causing distress for the LDI community going forward. But it still means that rates have to go up to a much higher regime.
Hey, Pete, we've got to leave it there. Thank you, sir. Peter Chatwell of Mizuho. Very relaxed about something that sounds pretty crazy in many ways.
It's so understated. He's like, there'll be more volatility. Other people are saying, it's going to crash the market.
Yeah,
They're going to have to come in with something
How many
insane.
people have you heard say that they think QT actually happens
Exactly.
at the end of this month?
Very few people. People saying they're going to have to reverse it. So fascinating moment with a moment of calm there.
Yeah, gilt's rallying this morning, that's for sure. We're down about 12 basis points on 10s, on 30s. We're down 18. In the next hour, we'll catch up with Katie Kaminsky, the Chief Research Strategist at Alpha Simplex, as we count you down to the CPI report, 8:30 Eastern Time, a couple of hours away from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The International Energy Agency says OPEC's decision to sharply curtail oil production threatens to push prices to levels that tip the global economy into recession. The head of the IEA Oil Market Division spoke to Bloomberg.
We're not calling on OPEC we're not setting their policy. Obviously, this is for the OPEC to decide. What we're saying is that by cutting supplies to the market, it's preventing a rebuilding of inventories that are still critically low.
Demand is now expected to contract by 340,000 barrels a day in the fourth quarter. The U.S. is considering a total ban on Russian aluminum in response to the military escalation in Ukraine. Bloomberg's learned that the Biden administration is weighing a number of options, including an outright ban or a large increase in tariffs. Prices surged to a record in March after Russia's invasion. Russia is second only to China as a producer of aluminum, which is crucial to most heavy industries. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy. I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. In a $7 trillion industry, there's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg.
So by moving at an aggressive but not an overwhelming pace, it allows us to get the funds rate up, to signal our commitment to keeping inflation in check and bringing it back down to 2%. But it also gives us some time to see how the economy is unfolding.
Fed speak is my favorite. That was Neil Kashkari of the Minneapolis Fed. Lisa, what's the difference between aggressive and overwhelming? What's the difference?
What's the difference between financial stability and price discovery? I mean, honestly, all of these things, it's very difficult to know.
If someone's aggressive to you, isn't that slightly overwhelming?
It depends. I mean, if they're aggressive with the thumbs up.
The Fed speak drives me nuts.
I know.
We're doing this aggressively, but it's not overwhelming, I promise you.
Well, this is again the difference between when does it become a financial stability problem, and the line is a lot thinner than people had realized. When you talk about what the pricing is and what financial stability is, hard to know what the differential there.
CPI coming up in 2 hours and 12 minutes time. Coming into that number, the price action shaping up as follows on the S&P 500. 6-day losing streak on the S&P into Thursday. Futures up this morning by 0.4%. Yields unchanged at 389.85. Euro dollar, slightly stronger euro in the mix here, 97.31. Firmer on that currency pair by 1/3%. Crude 87.40, up by a little more than 1/10%. Have you seen the statement from the Saudis?
Yeah,
I mean, come on, they are not backing away at all. Listen to this quote here from the Saudis. I'll read you the full paragraph. The government of the Kingdom of Saudi Arabia would also like to clarify that based on its belief in the importance of dialogue and exchange of views with its allies and partners outside of OPEC Plus and the group regarding the situation in the oil markets, the government of the Kingdom clarified through its continuous consultation with the US administration that all economic analyses indicate that postponing the OPEC Plus decision for a month, according to what has been suggested, would have had negative economic consequences. The Saudis right now are telling us that the US administration requested a 1-month delay to the decision. Now, the calendar's not lost on anyone.
Right.
It's the midterms next month.
Okay, so on one hand, this is Saudi Arabia either throwing President Biden under the bus or showing that he's politically motivated and that any of his jawboning is politically motivated. On the flip side, you also got an IEA, an International Energy Agency report out this morning, parroting what the administration has been saying, that OPEC Plus, the fact that they're cutting production right now risks a price spike. Is this a matter of geopolitical fragmentation with alliances getting on either side, or is this an issue of perhaps OPEC Plus, as you've pointed out, being the plus, the Russia alliance, given the time and the conflict with Ukraine?
Will Kennedy joins us now out of London, Bloomberg's very own and one of our best. Hey, Will, it's not getting any calmer, is it?
No, this rift between Washington and Riyadh is plain for everyone to see. A war of words, a diplomatic spat, however you want to phrase it. It's pretty extraordinary for them to put out a public statement showing the inside of their diplomatic relationship with Washington, and it suggests a lot of bad feelings on both sides.
And what does this mean in terms of what the reality is? I mean, who do you trust, Will, in terms of who's the correct actor in response to supply and demand, and who potentially is either politically motivated or acting out of a lack of capacity to produce oil, even if there were an increased demand?
Well, I think that both sides can credibly argue their position there. Saudi Arabia is keen to keep prices strong and very worried about the potential impact of monetary policy and the slowdown in the global economy, and thinks that the prudent thing to do to ensure stability in the markets is to cut now before you're faced with oversupply. On the other hand, Washington will see it differently. Biden has been incredibly focused on gasoline prices and in fact achieved a lot. Prices fell for a number of months. It will be worried about that reversing, and it's very concerned and has made clear its concern about the potential of a price spike over the winter as Europe grapples with its energy crunch, putting demand on oil too, and as European sanctions on Russian oil kick in early December. A big change to the way the global oil trade works.
Well, amid this political fog, and frankly the fog of different idiosyncratic markets, with the diesel market prices still surging on the heels of lack of refinery capacity, there's a question of just what the inventories look like. And I point to the IEA report showing that in developed nations, inventories are 243 million barrels below their 5-year average. Can you give us a sense of how significant this is, how vulnerable this makes developed nations heading into a winter where there are a lot of questions about capacity to supply a lot of the developed world?
I think a point that the IEA and as a representative of consuming nations, including the US and Europe, would make is that with inventories that much lower, it's an odd decision for OPEC to cut back on production, and the IEA has clearly highlighted the risk of inventories falling through the winter and into next year, and the vulnerability to the market. Diesel is a particular problem, and I think it's something that people need to be very alive to. It is a lack of refining capacity, and that's being exacerbated right now in Europe by strikes at French refineries. The market is very sensitive. There was a flaring incident at a big refinery in Holland this morning, and that kind of thing gets people jumpy when you're operating a system at maximum capacity. Accidents and unexpected incidents matter. Now, that tightness exists in the US as well. There's a lot of concern about diesel stocks, especially in the northeast of the US, where heating oil is used to heat homes. And a lot of diesel is going from the US to Europe. So it's a difficult situation, and I think we've seen different parts of the energy complex flare up over the last year. Diesel is somewhere where we need to concentrate our attention in the months ahead.
Well, just a final word on the SPR. This administration has drained the SPR to 4-decade lows. They've accused OPEC Plus of being short-sighted, but I just wonder if that accusation could be leveled at this administration as well. Aren't they now more exposed to the whims of OPEC Plus next year because of how much they've drained the SPR this year?
Yeah, it's the problem of fighting a issue of flow with stocks. Your stocks run down very quickly, and you can argue that the SPR intervention in some senses has been successful. At a time of turmoil in energy markets, it has kept gasoline prices low. But of course, as you say, John, there is a downside, and to use a metaphor, they will run out of bullets. So they need to hope that next year there is a bit of give in the oil market, that maybe OPEC has another look at the market, or new supply comes on from elsewhere. But at a time when shale production appears to be slowing, it is a difficult, perhaps, situation ahead.
Well, Kennedy, thank you, sir. Out of London, incredibly difficult, very complex, but the decisions that are being made now arguably make things more fragile next year. Same not just for the OPEC Plus decision and the oil markets, but also for gas in Europe.
Right.
We keep treating this stuff as a one-off shock, yet at the same time, the politicians are telling you that it's a huge permanent shift away from Russian energy as a source. So you have to ask yourself, how viable are some of these policies coming out of these countries, Europe as a region and America as a country?
Well, and this is a reason why the IEA pointed to the storage capacity and the fact that it's come down so dramatically, or the storage, the inventories have come down so dramatically around the world. But at what point, and I feel for policymakers in this capacity, because they don't want there to be a complete recession in the face of surging household prices for oil and gas. At the same time, how quickly can they really bring other supplies online?
Are viable energy policies consistent with getting re-elected? Viable long-term strategies over energy, are they consistent with getting elected on a very short-term calendar?
Well, this is the problem, and probably the reason why there hasn't been that kind of investment. And now, can they make the investment with money that is a lot more expensive to borrow?
Live from New York, this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader.
Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
For a young person who now looking at a career, would you recommend a Wall Street career today?
There are not many jobs you can have as a young individual where you're always learning.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
Inflation data 2 hours away in the United States of America. Live from New York City this morning. Good morning. Is the price action on the S&P. 6 days of losses into Thursday. We are positive by 0.5% on the S&P. On the Nasdaq, we're up by 0.2%. We are going to be hypersensitive to the inflation print 2 hours from now. In the bond market going into it, 2s, 10s, and 30s shaping up as follows on a 10-year yield. Your yield right now unchanged at 389.85 on a 2-year, just short of 430, just short of the highs of the year at 429.53. Lisa, core, that's the focus. Core month over month for Wall Street. As we often say, the front pages will go with headline year-over-year CPI. We're looking at core month over month. And I have to say, the expectations on Wall Street, they're not looking for a major pullback, are they?
No, they're looking for actually potentially new highs of the past 4 decades in terms of core inflation. And because of some of these longer lagging types of indicators like rent. So then what's the response in markets, right? The last time we got an upside surprise, markets sold off at the fastest pace going back to June of 2020. Is it the same, or is suddenly it's not necessarily clear what the Fed does with this other than what they've already communicated?
You'd have to imagine if we get a significant downside surprise, this market's like a springed coil.
I think that you're probably right.
Given the damage that has been inflicted on this market over the last 6 months or so, not just for this market, but for the gilt market too. Believe it or not, the Treasury market guided by what's happening with the gilt market too at the moment, and I think you will understand why. Yields on gilts at the moment, on a 30-year, down by 19 basis points, 463. The volatility in that market, I don't remember it being this volatile. The Chancellor had this to say late yesterday evening in Washington. Any fresh turmoil in markets would be, quote, a matter for the governor. At least a matter for the governor. I mean, what a line from the Chancellor in a difficult moment for this bond market.
That a lot of people, including the IMF, and you can argue that it was perhaps out of their mandate to be able to say this, a lot of people point the fingers at the budget, that this is their issue. This has nothing to do with the Bank of England and their decisions, at least over the near term.
It's everyone's issue now. Martin Will joins us, the Professor of Economics at King's College London and former Bank of England Monetary Policy Committee member. Martin, fantastic to catch up with you. Let's start broad, and let's start here. How difficult is it to preserve financial stability and address inflation simultaneously?
Well, historically, of course, it has been possible to address inflation and preserve financial stability. The difficulty we're seeing at the moment is that the Bank of England is having to try and manage the chaos that the government has been creating in the bond market. What the Bank of England would normally do would be to put up the bank rate to manage inflation. And of course, that doesn't feed directly through to the 30-year rate, but it's at the long end of the market where we've been seeing all these problems. And it's at the long end of the market that the implications are greatest for the pension funds, of course.
Martin, do you think that this Bank of England can really start quantitative tightening with the financial stability concerns that we've seen?
I must say I do wonder. Certainly, you might say, why be buying in a lot of government debt in October to start quantitative tightening slightly later? So we may see a pause on that at the MPC meeting, or possibly hear earlier about that. And of course, if that happens, then the argument for raising interest rates a bit more becomes all the stronger.
Do you think that Governor Bailey has messed up in terms of communication over the past 2 weeks, given the back and forth of, possibly talking with clients or talking with big investment firms in back rooms and saying perhaps we could extend the program, the emergency program, coming out with additional emergency measures, and then with a shock warning saying you guys have 3 days left, just to remind you, get your ducks in order, creating a bit of chaos. Do you think that he created an unnecessary degree of confusion in markets?
Well, I think he's been trying to manage an extremely difficult situation. Of course, where we will be if the problems do continue next week is unclear. My guess is that the Bank of England will have up its sleeve some form of more targeted intervention, but it is very much saying that the pension funds that need cash can raise cash in favourable circumstances at the moment. And my guess is that if they don't, then the Bank of England might make cash available, but on less favourable terms.
Martin, we've talked a lot about how resilient the system is post-GFC. I wonder if we look at this episode of the last couple of weeks and ask ourselves questions about how fragile it might be. Martin, a lot has been said about this administration, this government in the UK, a lot of criticism worldwide. It's all been pouring in. But Martin, what are the lessons we need to learn about how fragile, how resilient the system actually is?
Well, I suppose what none of us had expected would be that the system would face the sort of political shock, political economic shock that we've seen from Liz Truss's government. The assumption had been that the institutions were strong. Well, they have reasserted themselves, but the damage has been done. So, my view is that what we've learned is that if you get a government that pursues, say, very idiosyncratic policies, then you can have problems, and that's the sort of issue that perhaps people designing institutions hadn't thought of trying to protect themselves against.
The Bank of England is now in a very, very sticky spot. We're looking at the commentary coming from the governor, and I get the sense, Martin, I wonder if you share this view, that they seem to be very sensitive about contributing towards perceived fiscal dominance. And Martin, in a way, I wonder whether there's a risk here that they overdo it, trying to push back against that, and abdicate some of their responsibility when it comes to financial stability. Martin, can you walk me through how you gauge that kind of thing, that dynamic, those dimensions over the last week or so?
Well, I think everything is a tightrope. Obviously, at a time when inflation is high, the Bank of England must have been extremely unhappy about introducing measures that, for all the different circumstances, look in their structure very much like quantitative easing. Because, as we know, quantitative easing adds quite a lot to demand. It was intended to add to demand, and it works. And the Bank of England is certainly extremely nervous that, people might think, politicians might think, that it's going to put a lid on long-term interest rates in the long term. And if you do that, it does look very much like fiscal dominance. The function of the Bank of England would then become to provide the credit that the government needed, instead of what's established in law and practice, to control inflation. So the Bank of England is extremely nervous about that, and with good reason. They want the focus to be on their monetary role, controlling inflation, and they don't want anyone to think that their job is to get the government out of self-created difficulties.
So they've got to choose the lesser evil now, and I think that's really difficult, Martin, because they're stuck between a rock and a hard place. I'm sure you'd agree with that. If financial stability requires some kind of permanent facility from this Bank of England, are we sitting here and suggesting they may not be willing to provide it because they're too worried about how that might be perceived?
Well, insofar as we think of the problems with pension funds, of course, high interest rates actually make life easier for pension funds in the longer term. The problem is liquidity, at least as I understand it. And to the extent that the problem is liquidity, there are a number of ways in which the Bank of England can provide liquidity.
Martin, just final question. The Bank of England decision on November 3rd. As a former policymaker, let's put you around the table again. How would the events of the last month influence your decision about how big a rate hike we need?
Well, I think one thing that's going to influence decisions is what's actually announced in the fiscal statement on the 31st of October. And I think it was very deliberate that that's ahead of the MPC meeting so that the MPC can take that into account. But suppose in those circumstances the Chancellor doesn't offer any coherent way of balancing the budget, then I would be inclined to a stronger interest rate increase than would otherwise be the case, because, of course, an unbalanced budget is adding to demand in the economy. The Bank of England needs to restrict demand in order to bring inflation down.
Martin, I'm sure you wish you weren't on this MPC, that's for sure. Very lucky, fortunate perhaps. Martin Will, thank you, of King's College London. Can you imagine being on this MPC right now?
Well, when you were asking really good questions and important questions about facilitating their monetary regime or their fiscal regime of this particular administration, how much can central banks push back against the past 2 decades when they facilitated the borrowing binges of administrations around in the developed market?
But inflation wasn't a problem then, right?
But that's correct. So at what point can they stand up to the fiscal regime and say, this is your problem, and oh, by the way, if we have a financial stability problem, we're not going to step in because we can't, because inflation is a bigger issue and that is our primary mandate. What's their sort of correction mechanism with fiscal authorities at a time when the fiscal authorities are saying, actually, central bankers, it's on you, it always has been, so go for it?
They have a duty to provide financial stability. If markets aren't functioning, they have a duty to do something about that. And their concerns about perceived fiscal dominance, surely they would have to be set aside to fulfill their obligation to stabilize market functioning. You can't just abdicate that because you're worried about how decisions elsewhere might be perceived.
But it's not necessarily abdicating. There's a question of whether they can, right? Are they basically burning cash through a feudal enterprise of trying to create financial stability while doing something at the same time of combating inflation? How much is that what we're seeing right now in the United Kingdom, where they didn't get the response of people actually selling in bulk and remedying the issue quickly? And now they're stuck between a rock and a hard place of whether to extend some sort of emergency program indefinitely, even if there's no take-up, just as a possible cushion, and then not be able to do quantitative tightening.
This goes back to the first question we asked of Martin Wheel. How do you balance financial stability concerns with addressing inflation? And many people have said it's a challenge. Other people have said it's possible. Others just say it's almost impossible.
And how much does it politicize central banks that have only been successful with a significant modicum of independence? And this is really going to be a huge issue also at a time when there is this call from central bankers, please, fiscal policymakers, reduce your debt, make our job easier.
Given the size of their balance sheets, given everything they've done in the last 10 years, the idea that they weren't going to take stick from policymakers, politicians, elected officials was ridiculous. We had many people warning of that for the last decade, haven't we? I think you were one. You've been warning about that for a long time.
Well, look, and now the roosters are coming home to roost, or what is it? The chickens are coming home to roost.
Something like that. I think you can rethink that.
The capons are coming home to roost.
What are they called?
No, I was just,
okay.
they're
right, let's go. Futures up 20 on the S&P, up a half of 1% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Ukraine, the Kyiv region was struck by Iranian-made drones this morning as air raid sirens rang out across much of the country for a fourth morning. Airstrikes also continued in the south. Meanwhile, allies in Brussels for a NATO defense ministers meeting are expected to offer more air defense capabilities for Ukraine in face of Russia's stepped-up missile strikes. UK Chancellor Kwasi Kwarteng says the Bank of England will be responsible if markets suffer renewed volatility after the BOE's bond buying program ends on Friday. Asked about possible turmoil, he said that's a matter for the governor. Prime Minister Liz Truss is under pressure with her Conservative Party to backtrack on much of her tax plan, which roiled UK markets. Hong Kong is said to be considering easing property taxes and visa restrictions as authorities seek to curb the pandemic brain drain of recent years.
Bloomberg has learned Chief Executive John Lee could include the measures in his maiden policy address later this month. Hong Kong's strict pandemic measures have seen it lose ground to Singapore as an international financial hub. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, of the US, Europe and the UK, have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
If we do not see signs that inflation is moving down, my view continues to be that sizable increases in the target range for the federal funds rate should remain on the table. However, If inflation starts to decline, I believe a slower pace of rate increases would be appropriate.
Does it end next week?
I think so. I think
Does
it's
it, on the one hand this, on the one hand that?
Yeah.
Governor Bowman there of the Federal Reserve.
Well, does it end after the CPI report? Do we get a sense of, well, you're saying end in terms of the quiet period,
the
right?
Fed
You mean,
speak.
yeah, you
Yes.
just want a quiet period. You're like, please, just, enough already.
BlackRock assets down 16%. Hardly surprising, given the state of this market, right?
It actually underwhelmed people. People hadn't expected this degree of outflows. And the interesting thing is, when you have stocks and bonds both selling off, and you have this question about indexes and whether they'll work, how much are we going to be talking about over the next decade or so about whether indexing is perhaps an obsolete model at a time when a lot of the leadership, big tech, perhaps cannot participate in the way that they have in the past.
And passive doesn't dominate in the same way.
Correct.
Market cap weighted indices in a world like this one with higher interest rates doesn't work in the same way.
And what will be really compelling will be how much does that narrative stick, even as we get a recovery, if we do get the Fed lowering rates and going back to
not
where
doing
we were
much
before.
in the pre-market, and we can pick up on that a little bit later. Futures right now on the S&P up by 5 or 0.6% on the S&P 500. Down in DC, some of our best in Washington all week. I'm happy to say Tom Keene has got a great guest with him. Hey, TK.
Oh, John, good morning to you. It's fabulous to have John Lipsky here and watching him wave. He looks like King Charles, John, in a motorcade, waving to everybody in the early morning here coming in to the International Monetary Fund. He's a former first deputy managing director at the IMF, but far more. His public service for America and international economics is noted. We start strong today as we move to the managing director later this morning. Dr. Lipsky, thank you so much for joining Bloomberg.
It's always a pleasure,
You were the
Tom.
only one breathing who actually was at Plaza Accord. Everybody out, the media's having a media frenzy. It's going to be, we need another Plaza Accord in that. I don't want to go into a long discussion on this, but how do you respond to people that say we need 1982, 84, 85 again?
People forget the role of the Plaza Accord. The markets had started taking what was perceived as an overvalued dollar down beginning in February of 1985. The issue at the Plaza was, were the major central banks going to try to stop markets from taking it lower? It wasn't to initiate some new movement in markets, and in Plaza, they decided, no, we're happy with it going lower.
Right.
Later, they tried to say, at the Louvre Accord, stop, that's enough. Markets paid no attention and carried on.
Let's go from the set time of Salomon Brothers through all of your work to where we are now, and the common theme, and I go back to your important Hanoi speech when you first joined the IMF, is accord. And one of the things about Plaza Accord is everybody was on the same page.
Exactly.
You would suggest that the distinguishing feature right now in this crisis is the discord that you note.
Yes, or put better, everyone's focused on their own problems that they perceive are somewhat different than the others. There's a sense, yes, we have to fight inflation, yes, etc. But the sense of collaboration and effective cooperation that was present, for example, at the global financial crisis, is notable for its absence right now.
Ian Bremmer says it's every nation for itself, so here we are. We're taking examples. The chaos in Britain now is noted. Has that surprised you?
Yes, of course. But it all goes to show there in the markets there, when you put them under stress, you find faults and weaknesses that hadn't been perceived previously.
What are the faults and weaknesses in the United States right now? We sort of sit, we have the value of the dollar.
Yes.
This and the seigniorage of the dollar as well. We seem to have an easy road right now. Do you believe it is?
Relatively speaking. And it's, of course, in exchange rates, it's always relative to what? The U.S. is self-sufficient in energy, is a major commodity producer, and basically doesn't seem to have the same kinds of demand problems that others do. So it's, in relative terms, the problems seem tractable. So it's not so surprising that the dollar's been going up.
The key point now, and this is your wheelhouse, if you look at dollar strength and the weaknesses in emerging market, is it the same as before? Are there ghosts of the 90s here? Or what is the distinction now of peso, Philippine peso near 60, Korean won moving up as well, and the others?
Back then, in the 90s, there was a lot of borrowing by emerging economies in foreign currency, especially the dollar. hence a heightened sensitivity to movements in U.S. interest rates. That's still present and that's still important, but it's in the broader context of the global economic developments that is creating problems for some emerging economies, not all emerging economies, but many of low-income economies that don't produce energy and import commodities and have dollar debt or foreign currency debt are in a bad
John
place.
and Lisa, I want to get out front here with Dr. Lipsky today on my first question to the managing director. We're going to go mathy here, which you can do out of Wesley. The Wesleyan math was killer years ago. To me, it's all about the x-axis, and everyone's going so fast. Have you been surprised at the urgency of central banks to get up to a legitimate real interest rate? Are they moving too fast, trying to get too much done too quickly?
We'll only know that in hindsight. What's clear is they were slow to get off the dime, and now they have to act in a way to convince markets that they're really serious about maintaining anti-inflationary policies. So they're rushing to get to a place that they think they want to be.
They're rushing. What's the damage of rushing?
Oh, the damage could be too fast or too far. But we have to realize that a year and plus ago, no one saw the surge in inflation coming.
Right.
So our understanding of the process of price formation is clearly deficient right now.
John Farrow's in my ear saying we're out of time because it's inflation day in America. Yeah. It's inflation Thursday.
Yeah, but remember, that's a backward-looking number, and what counts is forward-looking.
I'll let you tell John Farrow that. John Lipsky, thank you so much. And keep waving at people as you walk by here. I think they want you to come back. John Lipsky with us here, the former First Deputy Managing Director of the IMF. His public service to America is noted. John, it is Inflation Thursday.
It is a backward-looking number. Tom Keene, thank you, sir. TK on the latest down in DC. Wonderful conversation. Should we tell everyone that at the top of the next hour? What you get at 8:30 Eastern Time is irrelevant. It's backward looking, except that's what this Fed responds to now, and that's why it's so important.
And that's what markets are going to respond to as well. So that's why it's also so important. So how much is it backward looking, and how much are the tea leaves of what's to come and the trajectory and the momentum behind certain indications? People looking, for example, at used cars as a way of getting a sense of how much consumer appetite is declining, and how much does that sort of link into this story that we have been talking about with assets falling? We were just talking about BlackRock.
Sure.
The assets falling, this idea that people feel less wealthy, and they're going to do less with that.
It's the compositional story of CPI that matters to pretty much everyone, particularly for earnings and for margins too. What part of the inflation story fades and what sticks? And if these companies lose pricing power at the same time wages remain sticky, then we've got a problem for earnings, right? Margins are going to be difficult, and a lot of people on the equity side are delivering that warning going into this earnings season and very worried about the guidance that comes with it for the next quarter and for next year too. Live from New York, inflation data about 95 minutes away. This is Bloomberg.
What are the biggest challenges for General Dynamics, and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, they're the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is not just a UK issue. This bond route is going global.
It's a big warning sign and it's a red flag, and we should not just assume just because we're in the United States we're immune from it.
The pressure is going to mount on the Fed.
We do think that there's a risk of a financial event that's going to feed into policy decisions.
This is the most challenging fundamental backdrop we've had in 40 years.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
CPI data 90 minutes away, live from New York City. Good morning, good morning. For our audience worldwide this morning, this is Bloomberg Surveillance on TV and radio. Here in New York City, alongside Lisa Abramowitz, I'm Jonathan Farrow. Equity futures negative 0.5%, or rather positive 0.5%. So used to saying negative because we've had 6 straight days of it coming into Thursday.
And if we have a 7th, it'll be the longest losing streak going back to February of 2020, just to give you a sense of how unusual, hitting the lowest levels since late 2020 yesterday, yet again.
We say this often, that the headline number on inflation is for the front page of the newspaper, that core month over month is what this market is focused on. Let's start with core.
Core is going to probably increase. That is the market expectation. If you start to feel that perhaps we've seen peak inflation on the headline number, but not necessarily in the core, what does that do for the Fed? Does that mean that they have to be more aggressive and kind of squelch those voices on the outside saying, oh, we're getting a little bit worried about what's happening with financial stability?
Looking for another 75 after this, ultimately?
Ultimately. People are looking for 75. There is a greater number of Wall Street analysts who are pointing to perhaps a 50 after that, but we will have to see what these numbers say.
It's the step down bullish if the economy's rolling over with it.
So Ben Laidler was saying that that's actually going to be the light at the end of the tunnel, and then Mike Wilson says that that light at the end of the tunnel is freight train coming straight at you.
I love that line from Morgan Stanley. It's wonderful.
It's poetry.
If you're very bearish, like someone.
Like me?
Futures up
totally
0.5% on the S&P 500. Cross-asset price action looks a little something like this. And the bond market shaping up as follows. Your yield's coming about a basis point, 388, 83. You got those complaints about, stop being so bearish. And I'm like, what would you prefer? That I was bullish all year?
and be wrong?
And be wrong?
Yeah.
And like just pretend everything's okay?
Well, if you'd been bullish, maybe everybody else would have made some profits.
They're not my views either. I'm just literally just bringing the view from, say, Morgan Stanley who's saying X and comparing it to the bulls who have been wrong who are saying Y.
It's your fault that people lost money today.
Ridiculous. It drives me insane. It drives me insane. I'm flattered that people think I even make a difference, so let's leave that.
Perhaps the way that we see the CPI numbers come in will give people a bit of a reprieve, maybe, although I'm actually struggling to understand what the market response could be that would be overwhelmingly positive unless we get an incredible downside surprise. U.S. September CPI report comes out at 8:30 a.m. We are watching core. The expectation is for it to rise to 6.5% from 6.3% year over year. An upside surprise could potentially cause significant pain, and a downside surprise, again, we will question, does this mean that the economy is rolling over very quickly? Is this a positive thing or a negative thing? Today, who is not in Washington, D.C.? Global finance leaders, public and private, all there for the IIF, the IMF, a G20 meeting, and much more. Among the people who I'm watching, J.P. Morgan CEO and Chair Jamie Dimon and Citigroup Chair John Dugan, both speaking at 2 and 3 p.m. respectively at the IIF. How much do they give a forward-looking indicator? I mean, we are going to have a backward-looking indicator of the CPI. Earnings, very much a forward indicator, particularly with respect to how fragile some of the financial issues are becoming. And at 1 p.m., the U.S. is planning to sell $18 billion of 30-year bonds. And this follows yesterday's auction that was not great of 10-year notes. And people really did not step in, even though the yields were the highest since 2009. Do we get a similar kind of tepid response to this auction, especially given what we're seeing, John, over in the United Kingdom?
Did you just do a bond auction just for Tom?
I always do a bond auction just for Tom. I mean, every day I see it, I'm like, yes, I can make him go a little nuts.
We sent him down to Washington. I think we sent pretty much everyone down to D.C. this week. TK, walk us through what's coming up this hour.
I'm going to walk you through this, John. I thought your Peter Chatwell conversation was absolutely fascinating, and you nailed it with him where he tried to game out where the real rate is heading to. That's also the major focus of the managing director of the IMF. We'll speak to Dr. Georgieva here later. This is an extraordinary meeting, John, by far and away the most tension-filled one since 2008. But as you heard from John Lipsky, it goes back further than that. With Georgieva, John, I thought the Chatwell, when you stopped Chatwell in this conversation, John, I thought that was brilliant about, okay, how do you get out to a 2.5% real rate?
I don't know how you get out a single month from here, Tom. Can you get out a couple of weeks? Tom, tell me how the ability of these policymakers in D.C., are they able to look out beyond 3 months? What does next year look like to them?
They are able to look out beyond. No, they don't know what's going to be out there 3 years, but they're trying as hard to say we can't be certain out 6 months or a year. And that's where you get the fury about the British challenges right now. They just don't need these little crises along the way of bad theory. That goes to the letter that Georgieva wrote to the United Kingdom here a number of days ago.
I know you're going to be talking about that, Tom. Looking forward to it. TK coming up with the IMF Managing Director a little bit later. Coming up with the World Bank President as well later this hour. Looking forward to that conversation. I've been excited for this one. Katie Kaminsky joins us now, Chief Research Strategist at Alpha Simplex. Katie, you're also a PM. Can you tell me how you've done so far this year?
Just under 50%.
Positive.
Yes.
How on earth have you done that?
We're bears this year. So I'd say you were talking about the bears and the bulls. It has been an extremely trending environment this year. So you've seen very strong asset class trends. So those of us on the systematic space, those that are following momentum and are able to actually short and adjust our positions, have found really interesting opportunities for those that can actually or are willing to take those type of positions. I mean, we've talked about the short bond trade all year. It hadn't worked since 1994. It continues to work, and it's been the biggest theme this month or the last few weeks.
So based on where trends are right now, it's getting a little choppier. Is it getting harder to really have a full bearish narrative at a time when a growing number of investors are starting to get bullish, at least vocally, about long bonds?
That's a good point, but look at what we just saw. I mean, we're also seeing volumes down. People are really hesitant. That means they think the market isn't oversold yet and that we're not going to hit the bottom yet. I think that's why you're seeing people so hesitant this week in the last recent periods, because we've seen correlations so high across assets that the market is focused on one theme: inflation, rising rates, and nothing else. That's really manifesting itself in the way that asset classes are behaving. And you're really seeing this whole market polarized on one number, which seems silly if you look at the big picture, but it really is the central point of where are we going? What's the next step?
A lot of people talk about the difficulty in liquidity and liquid conditions right now. How much is your strategy amenable to a significant amount of assets versus being nimble? In other words, does size matter when it comes to earning 49% so far this year?
So we trade in the futures markets, and futures markets are some of the most liquid markets out there, and they're a good place to actually realize and sort of take different risk exposures, particularly in the fixed income markets. Now, trying to short cash bonds is a much more difficult proposition because you have to borrow those bonds. There's all sorts of issues with the leverage and sort of credit, personal credit, whereas futures markets are a place where most people go when they have a view. If they have a view that the bonds should go down farther and yields should go up, they go there. And that is sort of a general mechanism of a very functioning market.
Katie, a lot of the time people become married to the view they have in a market, particularly when they're rewarded for it over a year like you have. Katie, can you help us understand the process that you'll go through to understand when you need to make a move the other way? Do you have a checklist? How does it work?
That's a good point. And this is something we get a lot of questions about as systematic traders. Our main goal is not to have bias. And I think what's been the most fascinating to me this year is how much people have long bias to bonds and how they've never thought about bonds going down. And so for us, the goal isn't necessarily to decide what should happen. It's supposed to be focusing on what is happening. And what is happening now is very extreme. And you're seeing very strong bearish trends across multiple asset classes, something that for most people is very uncomfortable based on what they're used to over the last few decades.
With really strong positive correlations cross asset, do you see that breaking down, Katie, at the moment? What are you seeing?
We've seen actually a big spike in the last 2-3 weeks, particularly in currencies and fixed income. You've seen the volatility in those two sectors spike significantly based on the theme that I just discussed. You're also seeing correlations on the order of 40% over short intervals, something that is sometimes negative. So you're really seeing the whole market in a shorter term horizon focused on one theme. And I think depending on how the numbers go today, you're either going to see that get a little bit dissipated because people realize the fear that they were looking for, or you see it accelerate because it confirms the things that they are willing to be, that they're afraid of. So that's why today is a big day in markets for the U.S.
Katie Kaminsky, congratulations on the year so far. And let's catch up before the year is out of Alpha Simplex. Just phenomenal performance from her and the team.
Yeah,
absolutely phenomenal.
And she was talking about the correlations, and I was looking at data yesterday that showed that the link between the S&P 500 and the Citigroup Economic Surprise Index is the most negative correlation going back to 2015. Basically, bad news, or good news is the most bad news for markets that it's been going back to 2015. And it just sort of shows exactly what she's talking about. The correlations are getting that much more entrenched as people kind of are more and more married to their views and look to the data to kind of confirm them.
Everyone's worried about everything. I think it was Boaz Weinstein at our conference here at Bloomberg talking about that just yesterday. Some of it resonated with me because I wonder what we're going to worry about more in the new year. Is it going to be inflation still? Or do we start to focus almost exclusively on growth and growth rolling over? That's been a question we've asked through the whole of this summer. Still inflation, inflation, inflation. Does that change, adapt just a little bit in the next few months?
It's nuanced because if there is also inflation, how does this market respond to stagflation? How does this market respond to a Fed that cannot come back in because, yes, growth is waning, but inflation is not coming down quickly enough to really justify any type of slowdown by the Federal Reserve? And that's the worst case scenario. The best case scenario is some of the supply chain constraints getting eased up, as you've talked about, and that would create a much more benevolent picture.
Equity futures look like this, positive 0.5% on the S&P 500. Yields basically unchanged on a 10-year this morning, going pretty much nowhere. Your inflation data, 1 hour and 19 minutes away from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. BlackRock's profit fell 16% in the third quarter, along with equity and bond markets, as central banks continued raising interest rates to counter surging inflation. The world's biggest asset manager says the firm oversaw $7.96 trillion as of September 30th, the lowest since 2020. At least 15 countries of the NATO military alliance, including the UK and the Netherlands, have signed a letter of intent to join a long-term German project to create a European anti-missile shield, boosting protection for much of the continent. The system will have several layers to intercept various kinds of missiles from different heights. NATO defense chiefs are in Brussels today for a second day of meetings. Nigeria is considering restructuring its debt and extending the repayment period of its credit obligations. The country's finance minister tells Bloomberg the government has appointed consultants to advise as it faces rising debts.
We have just appointed a consultant to make an assessment of how we can be able to get additional relief by way of restructuring and stretching out negotiating to stretch out the repayments to longer periods.
Ahmed says the government also plans to refinance domestic debt obligations that are due this year and next. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund is typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg. Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
What's clear is they were slow to get off the dime, and now they have to act in a way to convince markets that they're really serious about maintaining anti-inflationary policies. So they're rushing to get to a place that they think they want to be.
Tom Keene with a series of brilliant interviews over the last 24 hours and another series of interviews still to come. That was John Lipsky, the former first Deputy Managing Director at the IMF, sitting down with Tom about an hour or so ago. Your equity market shaping up as follows going into the CPI print an hour and 12 minutes from now. Equity futures up by 0.7% on the S&P. Yields going kind of nowhere on a 10-year. We're down about a basis point, 388.42. Tom Keene, we've got the countdown clock ready. Inflation 1 hour and 12 minutes away.
Everybody here in Washington, John, will be looking for that U.S. CPI report, and as Lisa mentions, the core statistic. I'll be looking at Cleveland CPI or the Dallas Trim Mean, some of these custom indicators. But what they all mean and what we'll see at 8:30 is tension for the global financial system. If you're a geek on this, if you're part of Global Wall Street and want to dig deeper, this is the interview of the day. Tobias Adrian had the privilege of a PhD at MIT with Olivier Blanchard and the giant Stephen Ross. He is Director of Monetary Affairs and Capital Markets at the IMF. Let me cut right to it. You're the most popular guy at these meetings. What are you telling scared politicians? What are you telling scared central bankers?
Well, the number one goal for monetary policy is to get inflation back to target. In the vast majority of countries, inflation is well above target, and that is the primary concern.
Well, continue, please.
Having said that, financial stability is also at risk. So when we are looking at sort of like where we are over time in terms of financial stability, it is very concerning.
Over time, what will shift out of these meetings to over time? Will we have a more patient Jerome Powell?
Well, that's a good question. I would expect that what is priced in at the moment is what we are very comfortable with, and I do not see major changes there relative to what is priced in and relative to what was announced by the policymakers.
That thud you heard 4 days ago was me showing John Farrow in New York, British gilts out 7 standard deviations, price down, yield up. Yesterday, I believe, John will correct me, over 5%. Should we expect more 4, 5, 6, 7 standard deviation moves in fixed income?
Well, I think the Bank of England has had these targeted and temporary asset purchases that are scheduled to expire, and those have been successful in terms of bringing yields down temporarily and bringing them back up in a more gradual manner. Of course, the overall stance of monetary policy continues to be one of a tightening as inflation is above 10% in the UK.
I want you to go into your iconic green book on financial stability, or frankly instability. It is absolutely definitive in academics. What's a single chart our audience needs to know about?
Figure number 2. Figure number 2 shows the macro financial downside risk at the moment. And when you look at that chart, it's only in acute crisis that downside risk has been more elevated in the past 20 years.
What does that mean for Jerome Powell? Is he central banker to the world then?
Well, I'm very much in favor of the kind of policies that have been announced by the Federal Reserve. and we think this is the right path going forward.
But if they move 75 basis points, whatever, it's clearly nonlinear as we move to neutrality and restriction. Not to go back to Greenspanian measured approach, but are we going to see a more measured major central bank, not only us, but England and particularly ECB, are they going to be more measured because they're told to be more measured? My
expectation is that they will want to see inflation coming down back towards target, and at that point, it's going to be time to be more measured.
It's time now, folks, to get Tobias Adrian in trouble. Let's do that. Olivier Blanchard had the courage in these buildings to say we need to consider a 4% run rate on inflation. Adam Posen at the Peterson Institute says, well, maybe not 4%, but 3%. Is the end outcome 10 years from now or 15 years from now, we reset from 2% out to some form of inflation of 2.4, 2.8, or dare I say Posen's 3%?
The debate about the higher inflation target was at a time when inflation was too low. We were in a deflationary environment, and the argument was to raise the inflation target in order to be further away from deflation. At the moment, we have the opposite problem. We have too high inflation. So changing the inflation target when you're further away from the target, that would undermine credibility. So this is not the right time to change the inflation target to a higher level.
It's not right. It's not. What would be the
time.
catalyst to change the inflation rate?
It's if we're back down in a deflationary environment.
Okay, one final question. I know you've got 3 Bloombergs. The lights dim here in Washington when Tobias logs on to his Bloomberg. You look at foreign exchange. How do you use foreign exchange, and what are the signals of, say, yen 150, euro 0.90, or EMs giving way as well? What is that foreign exchange depreciation versus the dollar signal for your world of instability?
Absolutely. So financial conditions are tightening, and they're tightening relatively faster in the United States than in other countries. That is one of the major drivers for these exchange rates.
You have 40 meetings this week?
I have 40 bilaterals and 10 speaking engagements.
The only one that I've ever known who's had more bilats than you is John Farrow. Tobias Adrian, thank you so much. Director of Monetary and Capital Markets here at the International Monetary Fund. John, could you see you or me in 40 meetings in 3 days?
I don't think so. I don't think so. Not the morning after the long nights that you and I have had sometimes, Tom. Me propping TK up.
That would never happen.
Literally.
Yeah. Tom, thank you, sir. Over at the IMF down in Washington, D.C. What a tough moment for them. Not the moment to start talking about 3%. The question that Adam Posen is raising about next year is whether you get to next year and then they start talking about it.
Well, especially because, I mean, as Tobias Adrian was speaking, I was reading this Oxford Economics report and listening, don't worry, where he was talking, or they were talking about how the increasing risk of financial stability will cause an early phase out of quantitative tightening. And how much are we going to start to hear about this, which will necessitate a higher inflation rate for longer, because this does really create a problem or a ceiling for how much they can fight inflation.
It has been the real yield question of the week for the last 2 weeks. Will this Fed still be doing QT in 2023?
Can they afford to, or will something break? And if something breaks, can they afford to respond by ending quantitative tightening faster than they have laid out? It's just watching paint dry right now, John.
Yeah, they hope, they wish, right?
Oh, you're not buying that?
I don't buy that at all. That's what they want it to be.
Totally boring.
The market doesn't see it that way.
No, they don't. And
I know that some people do, but ultimately, on net, market participants don't see it that way at all.
Okay, and this is the reason why, and Tom, yes, I am talking to you, but this is the reason why I care about the auctions, because this is where we're not seeing the marginal buyer come back in, and that does have to do with quantitative tightening around the world. If there starts to be some sort of ballast, well, suddenly then do you get a ballast for risk pricing more broadly?
Do you think you're converting him?
No.
I don't either.
He's sleeping. There's no way he's interested.
Carl Riccadano's coming up from BNP Paribas.
He's interested.
He's very interested. He'll be joining us in about 5 minutes' time with 64 minutes to go until CPI in America. Where's the clock for it? Do we actually have a clock? I don't think we have a clock.
I feel like this should be the Jeopardy soundtrack.
That sounds like elevator music.
Well, it is.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry crossed $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Away from the opening bell. The shape of that opening will be dictated by what happens in the next 60 minutes. And 60 minutes at CPI in America. Equity futures going into that look like this. We're positive 0.6% on the S&P. We're up 1/3% on the NASDAQ 100. 6-day losing streak. You know that stat well. Coming into Thursday. In the bond market, highs of the year on a 2-year earlier this week. The high of the year just short of 435. 434.97 is your high of the year. The same week we had the lows of the year in the equity market. I think you can add up why. 428 is where we are on a 2-year right now. Yields in a couple of basis points on a 10-year maturity to 387.81. On a 30-year, down about a basis point to 386. When you look at the 30-year right now, it's not the Treasury market we're interested in. It's the gilt market. It's the UK. Allow me to frame this as a high-stakes blinket contest between fiscal authorities, the government, and the governor of the Bank of England. The governor is saying you've got 3 days. Well, you now have about 1.5 in the UK before their gilt market operation ends. And Lisa, the government is saying we're not ready to do a U-turn on our tax policy. So who blinks first, if anyone blinks, going into the end of this month?
And how much can this market take, right? I mean, how fragile is it? This is another issue that I don't really have a conclusive answer to. Have you gotten a clear answer to just how far some of these pension plan funds have really unwound their leverage? I don't have a sense of where we are in terms of the financial stability threat if the Bank of England does go through with this and says, we're not supporting you anymore.
I've heard from people that have told me that it's started to show up in US credit in a more pronounced way, that it perhaps explains what's happened in IG that hasn't happened elsewhere.
What you've seen is a disproportionate sell-off in top-rated investment-grade corporate bonds relative to high yield, which does not make sense heading into a financial downturn, as so many people predict, because typically it would be the more leveraged companies that would suffer more greatly. And yet, if you have UK pensions that are selling top-rated credit because they get the most money back for it, liquidate what you can, not what you want to, is that what we're seeing ripple into the U.S. markets?
I go back to something I said earlier this morning. You know, we can talk a lot about the UK government, whether they've made mistakes or not, and many people think they have. But did you think that £45 billion worth of tax cuts would trigger this kind of reaction, not just in the gilt market, but in global markets, the spillover from that to elsewhere? That surprised me too.
And this is the reason why financial stability, not in the United Kingdom, but globally, is now the main concern for so many people. What does it say about the fragility of the state that we're in if that's all it took to trigger such a massive ripple effect?
What's more interesting here, what they did or how the market responded to it?
Definitely with how the market responded to it.
Right, and do you think the Bank of England's been shocked by that too? I'd suggest they have been.
Which raises questions about quantitative tightening more broadly and what kind of ability central bankers have to keep going despite the rising fragility of many markets.
We should write a paper on this.
I think so.
It would be great.
Next break.
We can do that in Tom's next interview. Just make notes. Shanali Basak is down in DC as well. She's at the IIF, not the IMF. She's our Wall Street correspondent. Shonali, BlackRock out a little bit early this morning. You and I are going to have some long conversations tomorrow morning when the big banks come out. Give me a read on BlackRock. What does it mean for the big guys on Wall Street?
It's a great question because this is the moment of truth. How could a $10 trillion asset manager fare in the face of the storm? And the answer is assets have declined meaningfully this year. They're back below $8 trillion. It's the lowest level since 2020, John. Now, when you look at earnings per share, they have beat analyst estimates. However, you're seeing those long-term flows all year under pressure. I think it's important to see where exactly did flows turn negative. You're looking at negative flows in the retail clients, and then you're also seeing them in the institutional clients when it comes to index funds. This is at the end of the third quarter. The question is, how much has this continued since then to that pressure that Lisa has been talking about that a lot of institutional clients have felt and therefore have sold more liquid products first? You have Larry Fink in the statement really talking to the idea that there are flows in fixed income that are very, very strong still, and that there are flows into alternatives. I looked at the alternatives business. There is still pressure there when it comes to currencies and commodities. And again, this is at the end of the third quarter, so the question remains, how much more pain did they feel from there?
Shonali, this is definitely a bellwether company, considering its scope as an asset manager. Is there any sense that people are rethinking their commitment to index funds in the face of dramatic underperformance, particularly by big tech, which are some of the main components here?
That's a great question because this is an existential question for the big passive funds that have seen such a long bull market. And BlackRock, of course, is the king of this world. So that passive fund question is not only a question about whether what this means for market structure, market liquidity, but there's also a lot of questions about this business model in terms of the most liquid things you have to sell, you will sell first. That is stuff that you have in ETFs, for example. But again, the fixed income flows are interesting. Will Larry Fink be discussing more of a pivotal business shift as the world changes into QT and into a tougher macroeconomic environment, at least in the nearer term, maybe longer term? He is speaking, Larry Fink is speaking here at the IIF today at in the 5 p.m. hour. I will be listening. He will be addressing that macroeconomic outlook here.
Shonali, you and I are going to catch up again in about 2 hours' time, just around the opening bell. Looking forward to doing that. Shonali Basak there, down in Washington, D.C. They built a phenomenal business to surf the wave that dominated the last 10 years. That wave's starting to break, one, and two, to see him in the political crosshairs in the way that he has been, I'm speaking about Larry Fink, is fascinating as well at the moment.
Especially with ESG, environmental, social, and governance, and you have a number of states withdrawing cash from BlackRock, and you have a number of businesses not wanting to do business with them. It raises issues about being, a sort of a stakeholder rather than a shareholder, and some of the recent move in corporate America away from the Milton Friedman kind of model and how far they can go with that.
Fink sounded like a journalist recently. I think he said in the last 24 hours something like the left are annoyed with me, the right are annoyed with me. I hope I'm doing something right.
Well, it's, we can talk more about this. Nonetheless, it is a political concern at a time when there is this business consideration about the shift, and riding a bull market is a good way of putting it.
And Carl Riccadonna joins us now, Chief U.S. Economist at BNP Paribas. We are within 60 minutes away from CPI in America. Carl, let's just start here. The inflation print, what are you and the team at BNP looking for?
Well, I think looking at this morning's report, there's a few things we do know. We know that rents are sticky and running hot. We know that core service inflation is also sticky and running hot. So the real question is this issue of supply chain healing, and if that starts to materialize in lower core goods inflation. I think there's a compelling case if we look at the cost of shipping a container across the Pacific. It's down about 75% from the peak. A ripping dollar up about 16% year on year in the Bloomberg Dollar Index should be translating into declining import prices. We haven't seen that yet. There's a big inventory liquidation story. So there's a lot of elements to this supply chain healing story that make a compelling case for lower goods inflation going forward. There's not a compelling case that this happens in the month of September. So we'll be kind of watching around the margins for any clues that that's coming. Yesterday's PPI was not particularly encouraging, but this is kind of a key focal point going forward.
So how do you communicate this to clients? Because they've been burned by faith-based inflation reads for a long time, saying it's a backward-looking indicator and it's going to soften going forward. How do you communicate to them if you look at the chip sector, if you look at the retail sector, if you look at certain healing supply chains, you do see this year-over-year comp that's going to bring down inflation, but maybe this print, you can ignore this one too.
Well, I think whether we're talking about the Fed or private forecasters, there's much less certainty around the dynamics at the moment, as a lot of forecasters have been burned over the course of the last year, from team transitory onto other more moderate types of forecasters as well. And I think what we have to do is acknowledge what has occurred and the fact that we are starting to come off of the boil. So consumer prices will probably be the last shoe to drop as we see an inflection and some moderation on the inflation numbers. We can see in the PPI we're off of the peaks. Certainly as we look at inflation expectations numbers, whether it's from the New York Fed or the University of Michigan, they are off of the peaks as well. If we look at prices paid in the ISM survey, off the peak. So we can see a lot of kind of upstream signals that inflation is at least topping out. We certainly haven't seen the realized improvement just yet, but there's a compelling case to be made looking at historical relationships for some degree of improvement. Now, what's going to be difficult, the supply chain story only gets us so far. So the San Francisco Federal Reserve did some work showing about 40 to 50% of inflation at the moment is supply chain related. That doesn't get us back to 2%. What gets us back to 2% is a firm foot on the brake pedal from the Federal Reserve, meaning not only do we go into restrictive territory, but we hold that restrictive stance of monetary policy for an extended period, which in my own view, our team view here at BNP, is that this could stretch out over a 2-year horizon even.
Hey, Carl, we've got to leave it there. Just a bit of news on the other side of the pond. Carl Riccadonna, thank you, sir. We are reporting here at Bloomberg the UK officials are working on a U-turn for parts of Truss's tax cut plan. We also understand the same thing from Sky News moments ago in the UK, that talks are underway over whether to reverse parts of the mini budget. So these reports are coming from left, right and centre. You can see the price reaction to this. Lisa and I only minutes ago were talking about the prospect of a U-turn. Where would it come from? From the central bank or from the government? Off the back of this reporting, sterling is a whole lot stronger. Cable 112.54, up by 1.4% on that currency pair. The low of the session was 110.58. So that gives you an idea of the range this morning. The high was just a moment ago at 112.61. We already had a rally in the gilt market. I can tell you that rally is a whole lot bigger now. The 10-year gilt yield is down by 37 basis points to just north of 4%. The 30-year gilt, which has become a big focus for this market, is down by 42 basis points to 4.38. Now, we talked about the blinking contest. Lisa, is someone about to blink down on number 10 Downing Street?
It seems like Truss is about to blink first, and here's the issue. If she doesn't, if they come out and they say, just kidding, we're not going to do this, then what happens? I mean, honestly, the violent reaction shows what markets think of her proposal to cut taxes and boost spending in an unlimited fashion.
So Governor Bailey was criticised, heavily so, for reaffirming the deadline for his gilt operation, which is tomorrow. If they U-turn at number 10 Downing Street, does the villain start to look like a bit of a hero?
Yeah, and over to you, Governor. Just kidding. We're going to actually focus on doing something else, so, don't mind us.
Let's see if this transpires. Once again, nothing confirmed. Our reporting suggesting that officials in the UK are working on a U-turn for Truss's tax cut plan. Remains to be seen whether that U-turn actually materialises. We'll keep an eye on that. We'll keep another eye on inflation. 50 minutes away. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Ukraine, the Kyiv region was struck by Iranian-made drones this morning as air raid sirens rang out across much of the country for a fourth morning. Airstrikes also continued in the south. Meanwhile, allies in Brussels for a NATO defense ministers meeting are expected to offer more air defense capabilities for Ukraine in face of Russia's stepped-up missile strikes. The International Energy Agency says OPEC's decision to sharply curtail oil production threatens to push prices to levels that tip the global economy into recession. The head of the IEA Oil Market Division spoke to Bloomberg.
not calling on OPEC we're not setting their policy. Obviously, this is for the OPEC to decide. What we're saying is that by cutting supplies to the market, it's preventing a rebuilding of inventories that are still critically low.
Demand is now expected to contract by 340,000 barrels a day in the fourth quarter. North Korea's state media says leader Kim Jong-un has supervised tests of long-range cruise missiles in recent days. Kim says the missiles are intended for tactical nuclear strikes, while warning Washington that any attempted attack could be met by strikes at American forces in South Korea and Japan. The comments are a fresh sign that North Korea could be preparing for its first nuclear test since September 2017. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself